Oh, it's in the commodity price, that's for sure. Copper through 9,000. Goldman talking.
In Chicago, it's 3 point something.
Goldman talking up 11,500.
9,000 to 11,000.
Copper.
Big move.
Just wow. Huge numbers. Futures unchanged here on the S&P. The inflation report just around the corner.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
To a certain extent, these forecasts about recession are a bit outdated.
The outlook for the world economy, I think, is actually improving.
Keep in mind, all the central banks in the developed world are still hiking rates.
The overhanging main event of the year is going to be what amount of damage have global central banks done to the economy.
I think perhaps for the end of 2023, risks actually are to the downside to the consensus.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The CPI in America, 90 minutes away. Your inflation report just around the corner. Live from New York City this morning. Good morning with Tom Keene. I'm Jonathan Ferro, counting you down to that report. In about 30 minutes' time, we'll also catch up with Torsten Slog of Apollo. Torsten with a note out just moments ago with the big question, I think the key question this morning, TK. Can the Fed and markets get inflation back down to 2% without a recession. And we see that happen.
Torsten's been on fire at Apollo, and it's going to be really good to get a base case for him before this 8:30 report. My problem with this is the idea that the Fed has an ability to guide inflation. As we heard earlier from Michael Pond, he would suggest wages are what guide inflation, and maybe a little bit of housing is a huge component for us, food for a huge component for us. I would also suggest on a rather large percentage of our listeners and viewers really don't care about core. They're living 6% inflation.
Yes, super core. How do you think we respond to that?
How do you respond to it?
We strip out
Forget
food,
about
energy, shelter.
Social message from Bloomberg Surveillance from Lisa, John, and I. In aisle 6 of Whole Foods, nobody cares. There's aisle 6 at a grocery store where I'm trying to get to Friday. 6% inflation matters.
It's a huge problem. So, Tom, we entered 2023 thinking we'd be talking about the price we'd have to pay for a year of monetary policy tightening, 400 basis points plus from the Federal Reserve, still more to come. And then everything gets complicated by China's reopening. We thought we had a nice, perhaps entrenched disinflationary trend on the good side of the equation. Does China complicate that? Then that's a question we've got to ask going into 8:30 Eastern Time.
China's too big. It always complicates, and it's about supply side shocks. Torsten's talking about still the supply side shocks off of the pandemic ebb. We're still in that dynamic, and that means we're still in a China, more of a China shadow than we usually are.
Counting it down to CPI, equity futures just about positive, up by almost 1/10% on the S&P 500. Yields coming back in by about a basis point on a 10-year, 352.43. In the FX market at the moment, 107.63. Euro dollar really not doing much on euro dollar. We mentioned Jordan Rochester of Nomura. They've updated their call, euro dollar. Tom, do you remember those calls? Sub parity, and now we're talking about 110, 116.
Well, things have changed. I mean, I'm sorry, I can't remember. I think it was Jordan today. They put in red ink on their black and white publication.
I saw that, yeah.
Things have changed. I mean, hello, things have changed. And I as I said yesterday to one of our fans from Western Indiana, I said, I'm sorry, we need to go to London where the shock is there and the nexus between Frankfurt and Washington.
I always want to trip you, D. Speaking of red ink, red ink right now on the Bloomberg. American Airlines, prelim, fourth quarter adjusted EPS, 112 to 117. The estimate, 60 cents. So I'm just looking at some of these numbers here. Fourth quarter revenue to be up 16 to 17% versus the fourth quarter of 2019. There's a turnaround for you. The stock is up by about 2% in the pre-market. Tom, 15.69.
Yeah, and it's amazing. I'm going to say the more beleaguered American Airlines and some of the other high flyers, that according to so many on the sell side. And I'm looking at the chart just coming, into the pandemic, it was on a trend downwards. Pandemic 30 to 10. And it's only come up $5 off of $10. A lot of these airlines have a lot of recovery space to go to get back to the nirvana of autumn 2019.
Early days in 23, January 12th, but decent start to the year for the airline stocks. At least we'll pick up on that a little bit later. Joining us now, I'm pleased to say, Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, wonderful to catch up with you. Inflation data, 8:30 Eastern Time. Run me through what you and the team are looking for. I asked this question yesterday. It's a difficult one to answer. Guessing the inflation's one thing. Working out what the market's going to do with it is another.
Yeah, hi. Well, we, like the rest of the market, have no choice but to follow what Powell is focusing on, which is that super core. I think it's a little bit dangerous, I have to say, to cut it down into such small components. There's so much margin for error there. But we, like everyone else, are going to be focusing on that. We're going to be looking at simply because of its read-through to wage pressures. Now, consensus, it says 0.3%, but I have to say I haven't seen anyone out there who's expecting 0.3% or even above. It's really 0.2%. So I think if there is anything which is above 0.2%, that's going to be a really negative market reaction. 0.2% below, we're probably flying a little bit from there.
Where are we on the service vector? Do you have a trend in place for service sector disinflation, and how does that fold over to the markets?
Yeah, look, we're looking at the numbers. I mean, I think services disinflation, we are expecting it to come through, right? So we are anticipating that core CPI, along with headline CPI, continues to come down over the next couple of months. And that's with core goods inflation. Let's take China out of the story at the moment because that could change a couple of things. But core services as well, as you start to see that economy moderating. Our concern really is around the middle of the year, right? So we think inflation can easily come down to around 4.5%. 4.5% beyond, though, is more of a challenge. So for us, it's really, we can go through the paces and follow the market and just watch what Powell's talking about. But I think the real story starts around the second quarter of the year when we start to see if inflation can meaningfully and easily push through that 4% barrier.
How does China play into this? You've got a beautiful idea, Seema, the idea of unleashing the dragon. Okay, so China comes back, whatever the number is. Leland Miller maybe doesn't get to 6%, but China improves. What does that do to investment allocation, institutional and retail, in America?
Well, look, it really does depend on not just this short-term post-reopening bounce, but how long can it be sustained? And whether or not it can be sustained is really going to be related to whether or not they continue to improve stimulus and keep pushing that forward, and also what they do to common prosperity goals. I mean, none of that stuff goes away. So it does start to tone down some of that optimism. But certainly for the next 6 months, it's generally good news. And I think the key beneficiaries here is actually beyond China. It's actually the Asia, the almost Southeast Asia key trade partners for China. So from an asset allocation perspective, we are looking at Asia a lot more. We are increasing exposure to places like Korea, Thailand, Malaysia. Those areas we think will benefit more. And Europe to some extent, as long as that growth rate for China is really sustained.
Can we talk about that? Just the miners that have absolutely ripped. We had a guest on yesterday talking about the likes of Rio. Rio's had a massive, massive monster rally off the lows of last year. Not just the miners, but also the banks as well. Seema, are there some sustainable tailwinds behind that rally? Or is that just a big bear market squeeze?
No, look, I think that when you look at the China story, inevitably you have to bring commodities into it. And as I said, I think the 6 months is great. Beyond there is a little bit more difficult to predict. I mean, I should say the kind of 6 month to 1 year horizon. Now, when it comes to the commodity space, because of that real uncertainty of the near term, you bring in geopolitics, you bring in supply pressures, and there's so many dynamics can really be disruptive for a near term view that we take more of a long term perspective. For that, we are still very positive, and anything that comes through in the near term from China, which is pushing commodity prices up, is a bonus. But certainly for us, it's a long-term story that we're looking at.
Seema Shah of Principal Asset Management. Seema, thank you. Wonderful to catch up. I think it was Chris Verone yesterday, wasn't it? Over at Strategas. Yeah. Looking at Rio. Been looking at Rio the last couple of months, and just to give you a feel of that, Rio off the lows of October. From the end of October, we've rallied almost 40% on that miner.
Yeah, and
the chart's unbelievable.
Yeah, the place to look here is Australia. I think it's not a secret to anybody. I'm with Seema. China opening of China means a Pacific Rim pop. I mean, as simple as that. And what's great about the miners and what's called the beta, their ability to move when they move, they're a small section for us. But, we make jokes about the Dorchester Bar and LME and all that.
It's a big deal for London.
Globally, it's a big deal.
Big deal for the
Big deal in London and big deal for a lot of the southern hemisphere. I mean, you look at Australia and you go from Sydney out to Perth. I mean, it's not what we think. You've got to go north of Perth to get to Rio, to get to BHP, to get to Broken Hill Properties.
Why do you pronounce it like that?
My mother did that. She read all of Neville Shute and years ago, including the classic On the Beach, and she would sit there and lecture us on Broken Hill Properties out by Adelaide, and then a town like Alice and all that, and then you'd go up from Perth up to where their other mines were.
Have you ever been to Perth?
No.
Why do you say it like
I've never been. I'm supposed to go to Sydney. I mean, Bloomberg's supposed to send me to Sydney, and they go, no,
you got.
I get to Singapore, and they go, come home, come home.
They're beautiful cities in Australia.
Yeah.
Very nice. Caterpillar, all-time high.
Yeah.
Cat's at an all-time high.
Have you been to Australia?
I have, yeah. Brisbane, Sydney, sure.
I would just go to Brisbane to see the Veronicas. I mean, I don't know, I'd love to see them in a club in Brisbane.
We'll get you over to the Gold Coast.
We should.
Yeah, we'll make that. This surveillance tour's going on a while, isn't it? Several stops. We start in Shanghai, we're going down to Brisbane.
We got a countdown clock, and they're going to de-emphasize a clock.
I think that's our career, Tom. 1 hour, 20 minutes to go.
Very, very true.
1 hour, 20 minutes to go until the inflation report in America. Futures look like this on the S&P 500, just about positive by 1/10 of 1%. Yields coming back in by a couple of basis points on a 10-year at the moment. Your 10-year, let's have a look, 352 on a 10-year right now.
Tom Waits nailed it,
You want to sing us out? Be careful, look at the clock. You've got 90 seconds left to sing. You want to go? People were tuning in this morning thinking this was going to be a super serious show going into CPI. I got a message a little bit earlier, Tom.
Tom Trabert's Blues.
You'll love this. We need Bramo. There's too much optimism right now.
It's true. It's true. We don't editorialize here, but I'm in Neil Dutta's camp.
Are you really?
Yeah, I am sick and tired of the gloom. I look at China. I mean, it's on cue. Come on, John. China's going to roll over and die. They had a party Congress in November. On a calendar date, boom, let's fix COVID, and off we go.
I'm in a cheap seat. I don't have to make a call, so I'm not making a call. It's the third year of pandemic economics. Every time we thought we knew what was going to happen, something else happened. We've had more than 400 basis points of tightening from the Federal Reserve, QT on top of that. The ECB is going to keep on going. So on the one hand, you've got the ramifications, consequences of that, and then you layer on top China kicking back in. Who knows what that's going to look like?
Back to 2008 when we did not use a countdown clock. Bring it up right now. This is a LIBOR chart. This was a Bloomberg red sticky moments ago. You see it first. Bloomberg reports that 3-month LIBOR, the benchmark that you saw in 2008, we return to that level on LIBOR. We're 4.6 standard deviations on 3-month U.S. LIBOR. John, that is a foundational statistic for Michael Pond, Ira Jersey, and fixed income.
We'll continue the conversation. David Kelly, the Chief Global Strategist at JP Morgan Asset Management, coming up.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Investors and the Federal Reserve will be looking closely at today's U.S. Consumer Price Index. The projected 5.7% increase would be well above the Fed's goal. That would help explain its intention of keeping higher interest rates for longer. But the year-over-year price growth would also show moderation. That CPI is due out 8:30 New York time. The UK and the European Union are preparing to enter an intense phase of negotiations to end their dispute over Brexit. The talks are set to begin next week. The disagreement has to do with trade. Both sides originally agreed to allow Northern Ireland to remain in the bloc's custom arrangements. So far, the UK has failed to implement parts of the accord. President Biden's efforts to quell a controversy over classified documents in his private possession has become more difficult. Aides have found a second set of papers. Now, that's likely to fuel criticism from Republicans, even though they dismiss more serious accusations against former President Trump. More than 7,000 striking nurses at 2 New York City hospitals will return to work today after reaching tentative deals. Union leaders say the workers at Montefiore Medical Center and Mount Sinai Hospital will see pay raises and improved working conditions. The strike began Monday morning after 4 months of contract negotiations fell through. And Subway is exploring a potential sale that would value the sandwich chain at more than $10 billion. Sources tell Bloomberg the process is still in the early stages and privately held company could decide against it. Subway is one of the world's largest quick-service restaurant chains with about 37,000 locations, but its rapid growth has been tapering off. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What What do you want to know today? Ask a question or visit SearchGo to find answers now.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Wall Street prepares for the latest read on inflation.
There's new optimism about a soft landing.
Inflation may be fading faster than some people thought.
Will headline inflation continue to ease?
It's really about the labor market, wage inflation, and services.
Peak inflation becomes your number 2 concern, and you get into a growth discussion.
Instant reaction on Bloomberg Surveillance.
This is good news for Chairman Powell.
The risk of doing too little, does it still outweigh the risk of doing too much?
How much do we see the worst of it versus just the beginning?
Inflation in focus today on Bloomberg.
David Rosenberg out on Twitter.
Best in class.
Oh, this is punchy. Take a listen to this. Just as rents and good prices start to deflate, Powell decides his favourite inflation measure excludes products and shelter. He is now targeting less than 30% of the CPI. David asks why. Answers his own question, because he needs ammo to tighten further into the longest, steepest yield curve inversion since 1981. It's pretty punchy stuff.
There's a history to this, folks. The advantage of watching surveillance. When he was at Merrill Lynch, opinionated, worshipped by the revenue producing team at Merrill Lynch. He would do an inflation report, John, and on the right side of the paper, he would have the subsets of inflation. I'm going to tell you 30, if not 40 subsets of inflation, and he would slice and dice them, which is what America, represented by Merrill Lynch, was living. That's the Rosenberg that's talking right there.
Super odd to me that only a few months ago, Chairman Powell implied there was no space for nuance, and now it's just tons of nuance every single day. Go back to Jackson Hole. That was no nuance, right? And now it's nuance. We're doing Supercore today, stripping it all out, this, that, and the other. What do you want to do? What are you looking for?
I'm reaching down here.
For what?
That's where I keep the tang, you know. I mean,
what's down there?
I'm going to try to reach down here without letting know. It's very important. I'm going to undo this right now. I mean, we're doing this here, and you know, Amory Horton will understand this. You're going to get me in trouble.
On radio.
So I'm going to put the surveillance cork in my mouth.
That's a big cork as well.
That's a big one.
You bought corks? Is that what you bought? Is that what's in the box?
I didn't buy his. Anne-Marie shipped them up to me.
Did AMA send you that?
Yeah, this one's a little big. I'll have to look for a little one.
Yeah. I can't say. Right, okay, let me reset with the market chat before I absolutely die with laughter.
I'm going to, but on inflation, I'm not going to end here. Come on, David Rosenberg is dead on.
Anything you're about to say seriously, just take a beat.
No.
The futures of the S&P up by about 1/10%. Inflation data, 1 hour, 11 minutes and 24 seconds away. Yields lower by a basis point. Tom, your 10-year, 52.43.
Amory Horton joins us right now. Amory, let's cut to the chase. And I thought Karen Tumulty on what they did right, the 20 Republican renegades, was great, going back to the foundation of the nation. It's about passing laws. There's a primal scream out there about inflation right now. Forget about all the surveillance mumbo jumbo. Inflation's 6%, and they're saying to Congress, do something. What are they going to do?
Well, you're going to have actually the House Republicans introducing a bill about reining in inflation. This is really something that's going to target the Biden administration. You know, Republicans continuously go after the Biden administration for the American Rescue Package because it sent out those checks to individuals who were, many of which were still collecting paychecks, and they said this only fueled inflation. So there's going to be a number of measures on the House side, but remember, this is gridlock in Washington, so it's not going to pass the Senate. So there's a number of issues that Republicans are going to do because obviously they have the power in the House, but it's not going to actually make it through Congress. But, Tom, I would say I would agree with what you said in the prior hour. Not that I think the administration has the data beforehand and the president's seen the numbers, but they obviously think today's print is going to be in their favor. And what they can show is that inflation is coming down, and at the same time, they have a strong labor market with a 3.5% unemployment rate. That is a very good sign for a president. But I imagine when the president speaks today at 10 a.m., he's also going to say, which he always does, is that more needs to be done when it comes to inflation. Because until everyday Americans go out and don't have to think about the price of groceries, of gasoline, which obviously we've seen come down, but really groceries and some services, then they can really, that's the only time they can really claim victory.
It's fascinating to me how it fits into the advisors to the president. Now, we've got a re-up of Treasury Secretary Yellen, right? That was reported a few days ago. What
Yes, that was a Bloomberg scoop.
What advice is he getting on inflation? It's just as simple as that.
It's a great question. I think there's a lot of different people in the president's ears. I mean, he has a wide variety of individuals he talks to, including, I don't know why you're laughing, but including Larry Summers, we know that he calls. He obviously has Treasury Secretary Yellen, which you mentioned she plans to stay through, and Biden has asked her to, especially as this year is going to be some difficult legislation like the debt ceiling to get through a divided Congress. He also takes input from people he meets on the street in Delaware, soccer moms, when he's out and about on his weekends and at home. Also, he calls up CEOs like Brian Moynihan, like the head of Walmart. He wants to get information on what consumers are facing from a wide variety of individuals, not just those think tankers or individuals in the West Wing.
Just to be clear, laughing because Tom keeps bringing out this box of corks. I have no idea where that came from.
Some fan sent it.
Someone actually sent
Somebody
that to you.
Sent me a box of corks when I say put a cork in my mouth.
That was actually
well, the hate mail's assumed, yeah.
That's brutal.
Well, you know.
AMH, you mentioned Secretary Yellen. Can we finish there? So Josh Wingrove did some reporting on this. Can you tell me, Anne-Marie, Josh and I were talking about this yesterday. I think it's important. Is it a big factor that we've got this debt ceiling debate coming up later this year, and he wanted someone, dare I say, almost apolitical, running Treasury, someone who was a little bit more focused on the economic side of things and maybe not really interested in some of the politics in the way some other people are?
I think it's obvious that Secretary Yellen doesn't like the politics, right? She is an academic. She was the Fed chair. This is very much so something, almost how she runs the Treasury is how she was a Fed chair, right? She looks at the data. She's very honest when she gives answers, which I think at times has gotten her into some political trouble and some political heat. But now it's going to be very tough negotiations with Congress to raise the debt ceiling. And this is something that, you know, the administration probably looks at her, who could be seen on both sides of the aisle as an academic, someone taken very seriously, even if you don't agree that of her politics sometimes or how she views the economy, they do have a lot of respect for her. So at this difficult year in terms of raising the debt ceiling, and also they're going to have to, you know, find a budget somehow to keep the government running, they think that she's the safest pair of hands.
Can't believe we're doing this all over again, Tom. All over again.
Well,
AMH down at DC, Anne-Marie, thank
days
you.
From now. I mean, the trend is in place. There's no question goods has come back. Services is maybe barely rolling over. There's a lot of customs of things. Ed Hyman looks at history at Evercore ISI and says we're going to plunge down 3%. I think he's got a shocking. Was just on talking about a sub 2% yield? Was that Michael Pond?
Michael Pond, potentially getting back below 2% on inflation.
In the defense of the Fed, they're moving fast. Where I take issue, which is why we were laughing about the stupid cork in the mouth, is I'm sorry, we forget with all our mumbo jumbo and bow tie talk, this is killing people right now. The nurses I see striking on 3rd Avenue at one of America's #1 hospitals are no different than the strikes in your United Kingdom.
Sure.
People are getting hammered.
You mentioned Japan a little bit earlier. I mentioned that survey from the BOJ. It's the BOJ's own survey. More than half of Japanese households said their livelihoods have worsened. 53% of households. That's the worst read we've seen since 2010.
And I'm making it up as I go. Somebody correct me. U.S., 6% inflation is painful given, that, as Ned Phelps would say, our dynamism. Okay? Europe, it's a lower number, 4%. Japan's way low. Anything over, off the top of my head, 1.5% inflation, that crushes the people of Japan. They're there right now.
And not so long ago, this was the goal. Over in Japan, this was the objective.
Absolutely, to reflate. Oh, absolutely.
Yeah, and
no
it's
question
happened.
about it.
And now what?
Well, Citigroup says they will abolish Citigroup, Mr. Murashima.
YCC's going. That's the call.
They mince no words. They will abolish YCC under Kuroda. How do you publish that if you don't know it? I mean, they've got to have an inside knowledge.
There's a local news report today in Japan suggesting there will be a rethink maybe as soon as next week. That's a local news report. I've got no idea.
Did I ever think an inflation report would be as interesting as Jobs Day? I never really...
That's been a story for the last 12 months.
Yeah.
Maybe longer, the last 18 months.
It's amazing.
And will be maybe for the next 6. And that's the challenge for this Fed. The one in the future that hasn't happened yet. What happens when unemployment starts climbing? Hasn't he yet? 3.5%. 3.5%. And people talking about the immaculate disinflation. We're on course for a soft landing. The Fed's getting it done.
Well, you know what's good?
We'll see.
We have Torsten Slok coming up. That's a good thing.
He's fantastic. Of Apollo, with us next on this program. Equity futures right now up a little more than 0.1%. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Inflation data in America, 60 minutes away. Going into it, equity futures look like this on the S&P 500, firmer by just 0.1%, and looking to build on the gains over the previous 2 days. Can we do that? Well, the fate of this market, at least for today, dictated by what happens in 60 minutes when we get inflation. In the bond market, 2s, 10s, and 30s look a little something like this. Your 10-year yield lower by 2 basis points to 352.25 on a 2-year yield, just a little bit higher by what, half a basis point, 422 on a 2-year yield this morning. What a finish on copper. Just some massive calls coming through. We're through 9,000 on copper. We did that yesterday. Just for you, Tom.
Thank you.
Goldman's Jeff Curry, 11,500 in copper this year, off the back of Goldman, making a call that China reopening is going to deliver a big, big boom in this commodity market. We're down about 0.4% on the day, Tom, but that's quite a call. And that has to be a factor in the conversation around the inflation story. this morning. If we get a softening, if we get more goods disinflation, does China and its reopening completely disrupt that theme?
Yeah.
In the months ahead?
And very importantly, this is a massive 4+ standard deviation move from -2 standard deviations way out over +2 standard deviations. Whether you're in Chicago or London, doesn't matter. This is copper vaulting higher.
There's a pretty tight consensus for expectations a little bit later this morning. You've got the headline year-over-year stuff, but the banks on Wall Street very focused on the month-over-month core, and maybe for many of you as well, the super core, which we can talk about later. These big banks out with their calls, JP Morgan, Citi, Morgan Stanley, Goldman, all forecasting something like a 0.3% increase in core inflation, Tom, month over month.
It's going to be interesting to see. Our team has done a great job of preparing you for this important inflation report. Michael Pond of Barclays, definitive on inflation-linked debt. Right now, Torsten Slok with us to say he's chief economist at Apollo, his service to Deutsche Bank over the years. And Dr. Hooper, well, guess what? He's been on fire with blistering notes the last couple days. And Torsten, to wax theoretical, as Chairman Powell did, I believe, in the last press conference, throwing out Okins, throwing out Phillips, throwing out all these other theories. I don't know if you mentioned the Taylor model. Wages is what matters to Michael Pond at Barclays. Wages matters to you, and that's a Phillips curve analysis. Is it dated, ancient, and to be forgotten?
Well, the issue today is that the economic models will tell you that we need demand destruction to get inflation to come down. In other words, we need a much higher unemployment rate. But the problem is, maybe inflation today is not driven by demand. Maybe inflation to some degree, and maybe to a large degree, as some Fed working papers show, is actually driven by supply. So maybe we don't need that much more demand destruction. Maybe we just need time to sort out the problems with the supply chains. Maybe we just need time to sort out some of the issues on the supply side. So there's a very important link missing in the Phillips curve and in the economic frameworks that I'm using, that the profession is using, that the Fed is using, which is basically saying that there's a lot of focus on demand destruction being needed to get inflation to come down. But so far, and this is really important, remember inflation peaked at 9.1 in June, now down to 7.1. And if I look at ECFC Go, we'll get 6.5 today on headline inflation. If that's the case, well, then we're trending lower without the unemployment rate going up. So far, it looks more like a soft landing because we're not having that significant increase in the unemployment rate that the Phillips curve would have predicted.
Do we have a trend and an inertial force, to doing physics envy here, do we have an inertial force to get us where Ed Hyman says we're going, which is sub 3% inflation? Does the vector push us down quickly, or do we sit here for a while?
See, that's the key question, and I don't think anyone knows the answer to that. But if we were the Fed, I think we would say, okay, we don't know what the answer really is.
We like to pretend we're the Fed. Continue.
But why don't we just remain hawkish to make sure that we go in that direction? And then we'll remain hawkish as much as is needed until we get down to 2, 3, maybe even 4. And then we can start to take the foot off the brake.
Slok, edge of Blanchard there.
You know, what's a seat at the Fed? Yeah. I'm not suggesting you want a seat at the Fed. Does China ruin all of this?
So the main issue really is that, as you know, of course, all too well, it used to be the case that households in China used to be at home involuntarily. Now, with the virus raging, a lot of households are staying at home voluntarily. So that means that we have not seen, if I look at the CRB index, that has not been moving higher. Commodity prices are not moving higher, as they should have if the China reopening was going to be a big deal for commodities. So at least up to this point, the conclusion must be that it's probably going to be a more drawn-out experience where throughout this year, we will probably get some lift in growth, some lift in inflation. But at this point, at least, it's still the case, even though it has been announced. If it was the case that we had a significant reopening announcement, then commodity prices should be going up, but now they're actually still going down.
The chairman says we're not as restrictive, sufficiently restrictive at the Federal Reserve. Do you think we are?
Well, that still also remains to be seen. I mean, we have raised the Fed funds rate at the fastest rate basically ever. So we don't really know very well. There's a lot of debate also in Fed papers about, has the transmission mechanism of monetary policy shortened? There was a Kansas City Fed paper that said, well, it probably has shortened because now they also have forward guidance and the balance sheet. But at the same time, we're not really seeing anything outside the interest rate sensitive components of GDP slowing down. So housing is slowing down, autos, durable goods. But those are the interest rate sensitive components. But they only make up about 20% of GDP. The 80% of GDP, which is airlines, which is hotels, which is restaurants, everything from concerts, sporting events, it's still red hot. So there's just not much sign, still quite of a slowdown in the service sector.
I can't imagine the first report you wrote where you knew David Folkerts Landau would read it. He owns the high ground on flows. What's the flow worry out there that we don't see coming right now? Given price change, Spain, France, United Kingdom, Japan, China. There's got to be not a rate story, but a flow story that we don't see coming. What is it?
Well, there's a lot of policy things going on globally on yield curve control, as you, of course, have talked about extensively. And what does that mean? That they have widened the band a little bit? Is more coming? And what might that mean going forward for future BOJ policy? Also in Europe, it has turned out now that we still will likely have a recession, but it has turned out in more recent data that it was not quite as bad as we had feared. But nevertheless, Europe still needs to go through energy transition. And finally, to your question, let's not forget the debt ceiling this summer. That certainly is also something.
You think that's a legit point of study?
So I think that one risk and one worry that one could have is start to think about, are the risks of downgrades of U.S. sovereign debt? I don't think that's likely, but we're definitely seeing some risks over there in terms of what that might mean in terms of more volatility in markets over the coming quarter.
How do you respond to people microanalyzing what we're going to see here in 53 minutes, 31 seconds? Oh my, OMG. Eggs, CPI, eggs are outrageously expensive. How should our audiences react to that?
So I would think mainly in terms of goods and services. It's not surprising that goods is slowing down because that's partly also again interest rate sensitive components, and also that China has been so weak and we haven't seen commodity prices go up. So that's why goods have been slowing. So I think a very important place to look in the CPI report is still to look at services, and perhaps most importantly to look at owner's equivalent rent and all the housing parts of the CPI, because we are all waiting for that to roll over, and Jay Powell has said very clearly we should expect that to roll over. But services is really the area that is most rigid in terms of it takes time before that starts coming down, and the sooner that comes down, the quicker the Fed will turn from this very hawkish stance to a more neutral stance.
How good are we at measuring shadow costs in these inflation prints?
Not very good, because also remember our textbook, as we spoke about with the Phillips curve, doesn't really take into account what is inside the CPI basket. And the CPI basket only, I mean, some areas that are directly a function of wages, which is a big issue at the moment, really are relatively limited to only 25–30%. So in that sense, we're not very good at measuring what the shadow costs are and what's actually going on out there in the economy.
Isn't that a bit messy? Ridiculous almost.
Well,
we're chasing numbers that aren't really backed up by anything.
The Fed
that
and
we
the ECB
experience.
just have to live with that and say we just have to work with what we got. And obviously, therefore, we all look, and they look much more than anyone else, at all kinds of other data for evidence of inflation. Is it coming down? And it is coming down. Average hourly earnings last Friday is still trending lower to now 4.6 in December. But it's still the case that the level of inflation, which is what the Fed focuses on, and this is very important, the Fed focuses on the level of inflation, but we in markets, we focus on the direction of travel and saying, hey, it's going down, so maybe I should be buying stocks, maybe I should be buying credit. But the Fed would say, no, don't do that, because the level at 7.1 where we are now is still too high.
The problem I have here, including the shock of ending World War II and even the tragedy of Europe before the Marshall Plan, is we have experience with high inflation, which usually, as Krugman's brought this up, and Hyman as well, and others, it comes in with a vengeance. Is that where we are right now?
Yeah, but what I think is also very important is that this whole episode will turn out to be transitory. But the reason why it's transitory is because the Fed reacted. So that's like saying that the patient survived because the patient got the right medication. In other words, we got the right medication from the Fed, and therefore inflation is coming down. So it will not become a prolonged period of high inflation.
How close are they to restrictive? Dominic Constant at Mizuho, just outstanding in his synthesis. He says we're edge is super restrictive right now. Are we? LIBOR back to 2008?
Yeah, so the key answer to that question is the R star and where is the level of the equilibrium exchange rate for the Fed, and that we are definitely above that level today, and that's about 2.5 or so. So in that sense, we are absolutely in restrictive territory. So that also means, as the forward curve on the OIS is telling me, that we should expect to see the Fed begin to cut rates, maybe not in the third quarter, but definitely, in my view, in the fourth quarter or going into next year, because we are in restrictive territory and we need to get back to that R-star level, at, as much as there's some issues about how that's measured, at around 2.5.
You're smiling. Why are you smiling?
I'm absolutely
hate this rate cut chat, don't you?
Fascinated where we are, and he's the wonderful Torsten Slok is put into a position where he's got to game out what's going to be solved by ex post, and what's going to be solved by is R and R starred and the presumed growth rate G. We're doing the algebra here, folks. It's Algebra Thursday. Stay with us. And the answer here is we've had, as Blanchard and others talk about Stiglitz, we've had R minus G, which has been a gift for 15 years. Is that gift over?
So I do think that it's over in the sense that we will not have the Fed funds rate go back to zero. When at least when I think about what is coming after we have been through this cycle and inflation is back again, then I do think that we will have a new regime where the level of the Fed funds rate will not be zero anytime soon. It will be closer, and this is what I'm guessing the Fed working papers are telling us, be closer to the R-star level of around 2.5.
You mentioned T. Can I finish on T?
Please.
Transitory. I don't want to let that slide. What is it about this moment that you just think is temporary, that you think doesn't stick? Because a lot of people do think we've moved into a higher inflation regime, that we've left behind the pre-pandemic years. Why do you think we haven't?
So the first, of course, thing is that the New York Fed just published a blog post saying that inflation persistence is actually coming down faster. So the first observation is we are seeing inflation persistence improve quicker. But to your point, I do think that eventually a lot of these things will work themselves out, both if the supply chains fix themselves and also if we are in more restrictive territory. That means that demand destruction, which is both in the pipeline, has already happened, will continue to get us back to the 2.5%. So I do think that the reason why it's transitory ultimately is because the Fed wants it to be transitory.
At the espresso bar at Davos, this guy just holds court. When he was at Deutsche Bank, he just holds. You should see this
You
guy
hold
at
court
the room
somewhere
at the
else
espresso bar.
in Davos, and it's not
Yeah,
the
well, I'm
espresso
sure
bar.
Apollo's de-emphasizing it, so, maybe...
It was the piano
Are you going to
bar.
be at Davos?
No, I will not. Are you going next week?
We haven't decided yet. We're thinking about it. But the answer is Torsten Slok.
I thought we had decided.
That was a clinic. That was a clinic that you just heard from Torsten Slok.
Have you not decided yet?
Huh?
I
just can't decide.
I've made a decision. I'll announce that tomorrow.
I told him I'm not going unless I can bring vet Bill.
Oh, you wanted the dog to come and a photographer.
Well, I want the dogs to come
and a photographer.
And the photographers are, that's part of the entourage.
Torsten, a clinic. Thanks for your perspective.
Brilliant.
Thank you, sir.
Just
and great notes recently, by the way. Thanks for sending them across. I really enjoyed them. Torsten Slok there of Apollo. Inflation data, 47 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Traders are betting that U.S. inflation is cooling. That would reduce pressure for aggressive rate hikes from the Federal Reserve. We'll get the latest consumer price index at 8:30 New York time. The projected 5.7% increase would be well above the Fed's goal, but the year-over-year price growth would also show moderation. The U.S. and Japan are taking steps to counter the growing challenge posed by China and its ties with Russia. They announced plans to strengthen defense cooperation on land, at sea, and in space. The U.S. plans to reorganize its forces in Japan so it can deter and respond better to increasing regional threats. Bloomberg's learned that a corrupted file led to the breakdown of an air safety system that prompted flights to be grounded across the U.S. Both the system that provides critical information to pilots and its backup failed. Almost 10,000 flights were delayed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
it means they have a Bloomberg.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions.
Deflation of the dollar here, or the popping of the dollar bubble, I think is a very big story for 2023 and beyond. Now, in the short term, I would say dollar is very oversold here. It would not surprise me to see it bounce. We're going to put in what I would call, in my world, a right shoulder in the dollar. I would be a seller of dollar strength.
Chris Verone was absolutely brilliant yesterday, joining us from Strategas, a bed company. Live from New York this morning, we're counting you down to the inflation data in America at 8:30 Eastern Time, which is about 43 minutes away. Your equity market going into it looks like this, up 0.2% on the S&P. Yields come in about a basis point. Your 10-year, 352.43. In the FX market, euro dollar 107.57. Monster yen strength today. Dollar yen moving lower by 1 percentage point off the back of a report that Japan, a local news report on the idea that Japan may be backing away, Tom, from a policy review, or rather introducing a policy review for next week.
To frame this out for those not keeping score, 150, 140, we went rapidly down to 132. We visited 129 for a spot of green tea, and then back up we came, and now we come down. We haven't tested those yen strengths that we saw weeks ago.
And now there's talk of backing away from yield curve control even more, maybe even completely over a city. China reopening is a big factor for all of us coming into 2023. I know it is for you at home as well. Here's a call from Eric Nelson of Wells Fargo. On the dollar, on the back of this reopening in China, we recommend buying Aussie dollar on dips, targeting a tactical gain of about 4%. The dollar should soften broadly over the next few weeks. Tom, that's a 1-month call, 4%.
Well, these are big moves. No, I'm glad you put this up, John. And this is really important. We're not talking about little tweaks here. A lot of different Wall Street FX types are looking at demonstrable big figure moves.
Tactical is the key word here. Tactical. Are these tailwinds behind some of these moves sustainable? This rally we're seeing in EM equities, bull market, the rally we're seeing in base metals, copper through 9K, Goldman saying 11,500 maybe later this year.
Sterling cast right now. Let's dive forward the conversation as we did. I thought Torsten Slack, how good was he of Apollo? Just brilliant. Really, really fancy.
I think you have to agree with him to think he's great. He's great. It's just fantastic perspective.
No, it's good. It's been really good.
Great notes he's put out recently.
Michael Pond, maybe sub 2% yield. We continue with Eric Nelson. He's macro strategist at Wells Fargo, and what he brings to this is really serious mathematical panache from Wake Forest and from Johns Hopkins University. Let's look out on the right side of the equation. We're living here in 45 minutes, Eric, and that is the epsilon, the uncertainty out there. What's our level of belief in the data this morning at 8:30?
Well, Tom, we've had two pretty soft CPI numbers the past 2 months. So to see a third one this month would, I think, give the Fed a little bit of comfort coming into the next meeting and perhaps going 25 basis points. I still think, though, the bigger question is the employment cost index at the end of this month. Powell's been very focused on wages, core services, excluding shelter. So I really think the wages are going to have to come in on the soft side, or maybe even on consensus, for the Fed to be comfortable going 25 basis points. And so abstracting from today's reaction, which could be choppy given the positioning, do think the dollar can continue to soften here over the next month or two.
Well, maybe there's a dollar dynamic to it, but let's stay there on the employment cost statistics coming out in a number of weeks. That's wages and benefits. The Wells Fargo's got a real knowledge base on this with your countrywide heritage. What is the dynamic of pure wages and benefits right now?
Well, I suspect the number that the Fed's going to be really focused on is that private wage number. And of course, we've had the average hourly earning numbers that have come in a little bit on the soft side, that nice downward revision last month. But the key with the ECI numbers is that it's composition adjusted, Tom, as you well know. This is something we're looking at within jobs. What are workers seeing? And that's why the Fed likes to focus on it so much. Now, we have seen a little bit of softness from Q2 to Q3. Question is, did that softness continue, or did we see a re-acceleration? I think that a re-acceleration would really spook the Fed, given what they're really focused on here, and that is the very low unemployment rate and the very high level of vacancies.
Eric, I'm looking at your dollar call. It's a tactical call. It's a short-term call. You seem to be cautious about the durability of this, Eric. Can you run me through just why you don't think some of this dollar weakness can hold?
Absolutely, John. To me, it's so much of it is a function of the incredible policy tightening we've had over the last year. The still very significant cost of living squeeze in places like Europe and the UK. I do think that there's been a little bit more optimism than I would expect around the sort of durability of the economic recovery here, and the fact that maybe we can put this sort of energy shock and the interest rate shock behind us. I'm not so convinced. So I still do worry a little bit about global growth over the next 3 to 6 months and beyond. About some of the persistent structural issues in China. Those may be rearing their head again. Need to see more evidence that the global economy can withstand this rate and energy shock before I'm convinced the dollar is heading lower on a more sustainable basis.
Eric, this line you've got, China reopening could be less supportive of CNH over time. Eric, run me through the thinking there.
Yeah, John, this is really a capital flow story. So we've obviously seen a lot of optimism around China reopening. Looking at the Hang Seng or the Golden Dragon indices, these have rallied a lot. And, that's great in the short term, but to me, the bigger issue here is, are we going to see a longer-term return of capital to China after what happened last year? I'm not so convinced there. And then maybe more fundamentally on the current account side, you're looking at a lot more tourism outflows. You're looking at a lot more probably goods imports and fewer goods exports as the global economy rolls over here. So to me, that's a pretty negative cocktail for the Chinese currency.
On the dollar dynamics, there's a lot of bets being played right now. And John mentioned a 4% move that we're looking at now. In foreign exchange, is it a big figure 2023? Can you make a legitimate bet?
Well, you certainly have to watch dollar yen, Tom. I know that's been something you've been talking about this morning. If the BOJ were to move policy again, you could certainly see several big figures in a very short space of time. I do worry, though, that the market is maybe a little bit too excited about a successive set of moves from the BOJ. For them to come out in December, change policy, and then say, we're done for a while, this is not normalization, and then do another move, they really risk destabilizing the JGB market and dollar yen. I don't think they want to do that. So I do think coming into next week, dollar yen has actually some upside risk if the BOJ disappoints.
Eric Nelson of Wells Fargo. Eric, thank you. Big call there on a variety of markets, Tom, including the Aussie. Just on the end there, on the Japanese yen. Maybe they disappoint. There's speculation this morning. And it's a major move, let's be clear. I say major, it's a big move relative to what's happening elsewhere. It's a snooze in G10 this morning. But if you look at the dollar against the Japanese yen, 130.71, it's a move of 1.3%. It's a move. And Tom, it's off the back of this local news report that maybe we get this policy review over at the BOJ next week.
You got 5 years of stasis. I'm going to call it at a 110 level. The moving average mark is exactly a 108-ish. And so up you go 108 to 150, weak yen, and you come down. And we've only come down about a third of the way. So they got a lot of room to do to, quote unquote, get back to normal on yen. I'm not predicting a 108, but I'm just saying technically that's sort of the break point of when they surged higher.
Normal is an interesting word. Can we get back to normal in the JGB market anytime soon?
No.
The amount of distortion we've had there for the amount of time, it's just been years and years and years of this now. I'm looking at the 10-year JGB at the moment. We've got this new threshold over at the BOJ in the last month or so. It's just 50 basis points, and we're just bumping right up against it, just right up against it at the moment. I think for a lot of people who want to express that yield curve control view, they're not doing it through the bond market, which is heavily distorted and manipulated by the BOJ. They're doing it through foreign exchange.
Yes, I agree with that strongly, that they're using the deepest, biggest playground to play in because of the liquidity, because of the visibility that you've completely lost within not only in foreign exchange, but in Japan foreign exchange, but in others as well. How come both you and I lean forward when Rosenberg publishes? I mean, that's what you do.
What's he said now?
I don't know. I haven't read it yet. All eyes on today's CPI report. The whisper is that it will be soft, which may help to explain the rally of late. that's just a little blurb there from Mr. Rosenberg getting ready here 30 minutes
And
away.
without doubt, this
Everybody's
market has been looking for a soft print in this report. That report is about 34 minutes away. Just to go through the estimates for you, your headline number, so this is headline year over year, CPI, we're looking for 6.5%. That's the median estimate. The previous number was 7.1. As I've said a few times, a lot of people on Wall Street very focused on the month-over-month core figure, just to try and establish a trend here. Ex-food, ex-energy, month-over-month, the estimate 0.3%. The previous read 0.2, and then Mike McKee gets fancy quickly, starts stripping all kinds of things out.
He had his morning workout. You know, he's ready.
He said it's not super core. He said it's Powell core.
I like that. I did not know that.
Powell core.
That's very good. He talks to you more than me. He doesn't talk to me.
Because I'm a friendly guy, Tom. You know, you're a little bristly sometimes.
He sent me the corks.
Did he? David Kelly of JP Morgan Asset Management coming up next.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Fed is really focused on some of the stickier measures of inflation.
They turned out to fall way behind the inflation curve, and I think they're trying to make up for that mistake.
You have this combination growth prospects improving, but central banks tightening to keep inflation down.
That trade-off between inflation and the U.S. labor market is always going to be in place.
We're kind of moving totally out of the inflation regime. We're moving into something new.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz on assignment. Tom Keene, a most important 30 minutes here to go to an inflation report of the United States of America. Much to talk about. Great guest this morning. Vincent Reinhart, the former head of research for the Fed, will be with us in this hour to slice and dice this report. John, simply, why is CPI now so important?
Has been for the last 18 months. It's what the Fed is targeting, and they want it lower, much lower. Will we get another shift lower today? We're expecting that on headline. A lot of people focused on month-over-month call. We'll discuss that. The number drops in 29 minutes. And will this set us up for another downshift step down over at the Federal Reserve to 25 basis points?
Let me go to that right now. I'm going to do it here in the Bloomberg Terminal. FOMC go, because, John, is this report at 8:30 about February 1, or is it about March 22nd, or even the May 3rd meeting?
I don't think they can make decisions about what happens beyond February 1st just yet, but I certainly think it could set us up for 25. The Boston Fed President, Susan Collins, was speaking to Ginna Smidak over at the New York Times just yesterday. She's leaning towards 25. Others might lean towards 50. Be nice to finally see some division on that FOMC, wouldn't it, Tom? Given that the outlook is pretty difficult to make at the moment, at least 1 year out.
I want to fold the market into this because we're moving today. We spent a lot of time on Japan. John, moments ago, SPX prints 4,000 on futures. Standard & Poor's futures up 11. Yes, they were there the middle of December, but this S&P 4,000 is a different 4,000 than 30 days ago.
So the consensus was first half dip, second half rip.
That worked.
Remember that? And all of a sudden,
and dip,
just to
or
be
dip
clear
and
here,
I can't remember.
January 12th. It's January 12th, and we're already having a conversation about maybe some cracks in that consensus. And to be fair, when many of these outlooks were written, do you remember at the back end of October, in November, when all these people get round a table and start talking about the year ahead, we all said the big asterisk there was China reopening. And you needed two versions. One version, China's still closed, another version, China reopening. And we're trying to work out what this all means. When that demand kicks back in, does it upset that disinflationary goods trend that we've seen more recently? I don't know.
I will go with that as being the elephant in the room. We've talked about this all morning. Look for Bloomberg Digital and YouTube to help you with that, folks, and the great conversations we've had. John, what I would emphasize is it's more than just China. And what I would look at is how corporations are adjusting, how people are adjusting, and we're adjusting at light speed to what seems to be a nascent disinflationary trend.
Well, how this market's adjusting too. The dire outlook on Europe. I mentioned the European banks. To see European banks, 40% plus from the lows of the summer. I mean, these are huge, huge moves. And not just them, the miners as well. Rio, we had Chris Verona Strategas mentioned them. EM equities, high yield spreads in the United States. The tightening. People are talking about recession in America, and high yield spreads are tighter, not wider.
Brent crude, $84 a barrel. I'm rounding it up there. Can you imagine Brent crude at 90.50? It's a different conversation.
Hey, Jeff Curry of Goldman.
We're not there yet.
They're looking for triple-digit crude.
Review copper. I think you've done a great job on that. I look at it sort of, but, Chicago's shut down. LME is open, John.
Through 9K in the last 24 hours. Goldman, 11,500.
Yeah.
This year, potentially. It's a big move, Tom. And largely off the back of Chinese demand kicking back in, which is why I say, and I keep saying it, if you've got this outlook of disinflation, I get it, but does that get upset by what's about to take place in China? That's the unknown.
26 minutes away. I want to do a formal data check, John. I'm going to start with the Bloomberg Financial Conditions Index, still elevated, a positive, accommodative number, not what Chairman Powell wants.
Equity futures with a lift up by 1/3 All this speculation last time around that just before the print there was a leak. Gone back and forth on that. Still no real clarity, Tom, as to what happened. Do you remember that? The seconds before the last inflation print where the market started to move on it before it even dropped. Let's hope we're getting none of that. Let's hope we're getting absolutely none of that.
That got some scrutiny. I mean, that got some follow-on scrutiny.
It should.
I agree. There's no question, folks, on the green and the red of the terminal that we saw that as well. Foreign exchange has been front and center this morning. Yen is somewhat stabilized here, off the shock in the news.
Real yen strength. I mean, look, it's a 1.4% move on dollar yen, Tom. Maybe take a snapshot of G10 on the FX screen on the terminal, which is WCRS if anyone's interested.
Very good.
You just see this massive outperformance of the yen, Tom, against the US dollar, and everything else is pretty snoozy.
There it is. Michael McKee set to join us here in a bit. Vincent Reinhardt with all of his expertise in a bit. But we start strong this hour with David Kelly. He's Chief Global Strategist, J.P. Morgan Asset Management. And with his academics in Ireland, I'm sorry, he brings an old world tinge to the new world this morning. Is it global disinflation, David Kelly?
Yes, I think it is. I think there's, even with China reopening, we've got softness in the U.S. economy, we've got softness in the European economy. But more than that, we've had time. We had this spike in commodity prices in the middle of last year. We've seen that gives us time to increase production, to increase distribution, to reduce consumption. And even if we see a pickup in growth in the second quarter and later on this year in the world, I think that's given suppliers time to get commodities to market. And because of that, I don't expect much of an inflationary impulse out of a Chinese reopening. And I think the big story still is inflation coming down over the course of this year.
David, what are the chances that the Fed is done after February?
I don't think they are. I wish they would be. I think they need to stop. This is a war that they've won, and they're in danger of tipping the economy into recession. I think they're making the fiscal problem worse. So I wish they would be done. But no, I think the debate right now is 25 basis points on February 1st. If we get an at consensus number or a below consensus number today, then I think that locks in 25 basis points. But I think the way the Fed, the majority of the Fed are thinking about this is they want to go 25 in February, they want to go 25 in March, they want to go 25 on May 3rd, and then hold it through the end of the year. That's what they want to do. The question is, will the economy be strong enough to allow them hold rates at that relatively high level? I think we'll sort of see that as the year plays out.
What are we learning so far about that, David? Is it still too soon to draw any conclusions about how resilient this economy is?
It is. I mean, what we know for sure is the economy is going to be growing slowly. We're at full employment, and we've got very little demographic growth. We've got a very low saving rate, and I think that's a big problem because what's happened is consumers have been living beyond their means for the last few years because of government handouts. And if they sort of try to normalize that saving rate, if they stop increasing their borrowing as much, that's going to slow consumer spending. Meanwhile, we're getting sandwiched by a high dollar and by very weak residential construction, and that's going to slow the economy. So I think we get no more than about 1 to 1.5% growth at best. But we could still avoid a recession. I mean, we're on the edge of something here, but it looks more like a swamp than a cliff.
Yeah, this is really well said, the idea that we're on the edge of something. David Kelly, with all the ambiguities that we have now, I'm going to voice Neil Duddy here of Renaissance Macro, the idea that yes, growth may come down, yes, wage growth may come down, but if we disinflate, real incomes could be stable, or actually real incomes, inflation-adjusted incomes could increase. Is that feasible?
Yes, it is feasible, at least in terms of wage income. But you still don't have any, you still got the hangover of government transfers going away. And with the personal saving rate at 2.4% right now, remember it was 7% in the second half of the last decade. So you could have income growing faster consumer spending as that saving rate goes up and still have very weak consumption. So I think even with some income gains, we're going to have very weak consumption.
What is your call on housing? Is a broad statement, rents, OER, home ownership, etc.
Yeah, I think we're already seeing rents crack. In fact, I think one of the many nefarious effects of this bonanza in terms of government stimulus during the pandemic is that it allowed landlords to increase rents on people who temporarily had the cash to pay them. But these people don't exist anymore. And so I think that's already pushing rents down. I think it'll push them down further. I just think that government data is very lagged on this in terms of inflation. But I think rents will slowly come down. I think single-family home building is going to be slow, but multifamilies continue to be pretty strong here. And remember, the housing industry never was booming. So even if it is in a slump here, it's not having the same impact on the economy as it did in the first decade of the century.
David Kelly of J.P. Morgan Asset Management. David, thank you, sir. Thank you very much. We are about 20 minutes away from CPI data in America, going into it. A bit of a lift on equity futures. Tom mentioned that a few moments ago. Equity futures up by 1/3% on the S&P 500. Yields look a little something like this in the bond market, lower by 3 basis points. Tom, at the moment, looking at a 10-year just a little bit lower to about 350.
We haven't talked enough about the real yield, a 127 on the real yield. Real yield comes in with further curve inversion. I mean, as I said, the ambiguities, which is sort of microeconomic talk. Jeff Curry would probably give me a quality C at Chicago in microeconomics on that. But the bottom line, John, is it's a jumble. It's the whole thing now.
Hey, Tom.
20 minutes away is a jumble.
Third year of pandemic economics.
Yeah.
Every single time the consensus has got it wrong. Why would this year be any different? With China kicking back in.
Shout
No
out.
idea.
Yeah. Alexandra Harris just publishing, and who does she quote on the LIBOR news of LIBOR back to 2007?
Go on.
A real benchmark for the time of Tim Geithner and Secretary Paulson and that. Priya Misra. Priya Misra on LIBOR back to 2007. This is a real moment for global Wall Street. It is supposed to reflect bank funding costs. As reserves are falling, banks are paying up for funding. And I take what Ms. Misra, with all of her brilliance, is saying there to what's tomorrow after the inflation report. Bank earnings start. It will be fascinating.
JP Morgan, Bank of America, on to next week, I think Tuesday, Morgan Stanley, Goldman. Do you know who's coming up in the next hour? Priya Misra of TD.
I did not know that.
Yeah, looking forward to catching up with her.
Well, this is the next hour. She's
next hour.
on radio or on TV?
On TV.
Oh, okay. Thank you.
9 a.m. Eastern Time with Jim Bianco, Bianco Research. Catching up with Jonathan Golliver, Credit Suisse as well, around the opening bell at about 9:30 Eastern Time. Coming up on this programme, after the inflation data, we'll catch up with Vincent Reinhardt of Dreyfus and Mellon. Up next, Will Kennedy, Bloomberg's very own.
We have Will Kennedy in it.
Joining us on the studio, who heads our world-class commodity coverage. He's going to drop by the studio here in New York. And Mike McKee's going to give you the playbook on what to look for in this CPI print in about 18 minutes.
Yeah, Will Kennedy's like the Three Stooges. Cotton. You have no idea what I'm talking about.
What are you talking about?
Cotton.
I just want you to keep going.
Cotton.
What
Larry
is this?
Curly.
Okay.
Cotton. Except copper.
You want to do that voice for copper?
Copper.
An oil?
Copper. It's my Curly imitation.
All right,
I can do this. You ready?
Are you done?
That's a lot of skill.
Our folks in radio do not want to see that. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, Sam Bankman-Fried says don't blame him for the collapse of his FTX crypto exchange. In a blog post, Bankman-Fried blamed crashing markets and an attack from a rival. He wrote, quote, "I didn't steal funds and I certainly didn't stash billions away." Bankman-Fried has pleaded not guilty to fraud and campaign finance law charges. Investors and the Federal Reserve will be looking closely at today's U.S. Consumer Price Index. The projected 5.7% increase would be well above the Fed's goal. That would help explain its intention of keeping interest rates higher for longer. But the year-over-year price growth would also show moderation. The CPI is out less than 20 minutes from now. President Biden's efforts to quell a controversy over classified documents in his private possession has become more difficult. Aides have found a second set of papers, and that's likely to fuel criticism from Republicans, even though they dismiss more serious accusations against former President Trump. American Airlines posted preliminary fourth-quarter profit and revenue that beat estimates. The carrier was helped by robust holiday travel demand. Americans' results support large U.S. airlines' claims that the industry will continue its recovery from the pandemic in 2023. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We have this combination of sort of a soft landing in the global economy. The worst case scenario didn't happen because natural gas prices in Europe came down because, it's warmer. Energy prices have come down. So that's really lifted some of the growth prospects there. And of course, China's reopening. So you have this combination of growth prospects improving, but central banks tightening to keep inflation down.
Kathy Jones of Charles Schwab there, weighing in. We are about 14 minutes away from inflation data in America. Going into it, equity futures look like this on the S&P, up by 1/3%. Yields come in, Tom, by 4 basis points. Your yield, 350.
Very good, John. We're going to get started here at 8:16 a.m. here with the inflation report coming up. Michael McKee to join in a minute, but Will Kennedy with us right now, and maybe on the linkage of inflation and commodities. Is it commodities inflation, or, as John has mentioned all morning, copper is just a statement on China reopening? I mean, to me, that overwhelms any industrial inflation.
We went into the start of the year with copper looking quite tight. Stockpiles are at very low levels. And, with people thinking about China reopening, investment, we got some news from China this week that they're going to invest many billions in their electricity grid. And that is just a huge demand driver for copper. So people see this as a very strong story. And of course, with copper, that feeds directly through into the wider economy and raises costs for people.
Does it does it float over to other things like aluminium? They do that okay?
Aluminium, yes, absolutely. Aluminum is driven by
it's kind of you will.
Things like investment in electricity too, and just your growth in China if they are going to boost the economy with spending. I think a lot of different metals look tight, and then there's the broader long-term picture of the energy transition, which drives huge demand for copper, nickel, new metals like lithium, and I do think many people see a strong story there.
So we drained the SPR aggressively last year.
Yeah.
We were told they're going to try and refill it in and around 70.
Yeah.
And now China starts to reopen, and I just wonder if we get back to 70.
I don't think that there are many people seeing 70 at the moment. I mean, people are feeling quite bullish about oil right now. Jeff Curry was on yesterday saying 110 is the Goldman view.
Triple digits, yeah.
Yeah, we've got hedge fund managers like Pierre Andorand, who's always bullish, but, called up 140 last week. There are a lot of optimistic views there about oil. Ultimately, it will depend on how far the economy slows here. But absent a really deep recession, 70 isn't really the vibe in the markets right now.
I don't expect you to have the numbers to hand, but could you guide us, at least give us an understanding of how much the Chinese built stockpiles over the last year? Did you see any difference in the Chinese imports of crude over the last year when they were locked down?
Yes, they weren't buying crude at the pace you'd expect. I think that they had filled a lot of it. I mean, it's a very opaque thing. I mean, the Chinese do not tell you how much crude they have in a stockpile. They clearly bought a lot of oil in the early stages of the pandemic when we had record low prices. And those strategic stockpiles were probably pretty full. Refiners did not get the import quotas that as high as they're getting now. So, yes, there was a dampening in demand to some extent, and I think it's reasonable to expect if we do fully reopen in China and we see some of the demand gains that people expect, that we will see higher imports.
When you built this, you, Stuart Wallace and Justin Kerrigan, built our hydrocarbon team. You had the courage to go downstream, out to distillates and out to refining and all that. What's the story, in America, but frankly in Europe too? What is the refinery story as we possibly revisit 100 a barrel?
Refining remains tight. We came out of the pandemic with less refinery capacity in America. We came out with less refinery capacity in Europe, and that's being added in the Middle East. It's being added in China. But that means people are moving oil all the way to Asia to get refined, and the product all the way back to Europe to get consumed to some extent. And on top of that, you've got Russian sanctions, which are just accentuating those kind of trends.
I can't keep up at the moment, Will. This is not the year that many people anticipated just a month or so ago. Well, great to have you with us in New York. Brent crude right now up by 1.4%, $83.80. WTI up by 1.3, $78 and about 50 cents. We are about 10 minutes away from the CPI report. It's just around the corner. Equity futures going into that up 0.4%. It gets real when Mike McKee drops by the studio. Mike McKee's dropped by the studio. Morning, Mike.
Speaking of the way things change, you never want to see me on CPI days till the last year or so.
Well, here we go.
Now it's become big.
Supercore, or rather Powell Core, as you said to me yesterday.
Powell Core is the ex-housing number, which is not forecast, but people expect it to continue to go down because the contemporaneous indicators suggest that rents are falling, and that you take housing out, the rest of core hopefully is falling. Interesting thing is CPI on a headline basis, and we'll thank Will for this, is expected to post its first negative quarter or month rather since May of 2002, because energy prices have gone down. So we're expecting a 0.1% drop there. The only thing to keep in mind, and I brought a chart along. You can't see it on radio, obviously, but in
it's good on radio.
In August, there was a forecast for a negative 0.1%, and it did not happen. As a matter of fact, inflation started to go back up again. So there is that risk. It's maybe not two-sided for the markets, but it is there.
People get very frustrated when we start taking out all the stuff that's important to them: food, energy, shelter. Why is this relevant? Why is it useful?
It's useful for the Fed in its analysis because they're trying to figure out whether inflation is going to come back or keep going down, and so they're looking at the individual components of the CPI report to see what's happening. And the problem is that inflation, especially the core, has been pushed up by the way the Bureau of Labor Statistics calculates the housing component, which is rents. And then they ask people, if you were to rent your house, what would it rent for today? And that's how they figure out.
That's how they figure it out?
That's how they figure out what housing prices are. Well, you don't buy a house every day, and people don't sign new rental agreements every day. So it takes a very long time for the data to get in and out of the report. But then there are people like Zillow and Apartments.com who produce contemporaneous numbers that show it going down.
They don't use actual rental contract statistics, or they don't use home ownership statistics. They ask you, what if you did this? Is that how they do it?
Well, they use rental statistics for the rental part, but they use them on a aggregate basis, everybody. So if you signed your lease a year ago, yours is still in there, and that increase is still in there. For homeowners, yes, that's the way they do it, is they ask people what they think their house would rent for. The idea was, this really came about during the great inflation of the 1970s, 80s, because mortgage costs were so high. And so they wanted to take mortgages out of the calculation.
Do they do it? They tell me they don't do it this way in England.
I'm not sure if they do it that way in the UK. I hope they don't. But I don't know for sure. It's kind of bizarre, isn't it? When people find this out for the first time, they really scratch their heads about it.
Do you trust the statistics, Mike, if they're guessing inflation in housing?
You kind of have to, because
there's no alternative. It's like China.
There's no alternative. They've been doing it for so long that I assume that they have statistically smoothed it enough to have a confidence level. I mean, most of these numbers are supposed to have a confidence level of 90%. So
can we finish on the leak? And I say the leak in inverted commas because we don't know if there was a leak.
We need to pull that up, the Bloomberg chart.
So what happened?
Well, in the last minute before the last CPI report, trading was 3 times what it was after right before the normal CPI reports for the last 2 years. So somebody either knew something or thought they knew something.
Guys,
and
it was Bramo's kids on the couch.
It could have been. But maybe that's why she's not here.
That's why
winning the lottery.
In all seriousness, though, this is a problem.
Yeah, the Bureau of Labor Statistics investigated and said there was no indication of any leak, any information getting out. So how did this happen? We don't know.
Out of interest, when does the administration find out about this number? We know when they find out about payrolls. What about CPI?
Council of Economic Advisors gets it the night before, and they can share it with the president, which often they do, I suppose, if it's good news. Don't want to be the one bringing him the bad news.
No.
But other than that, it should not get out.
The president, of course, speaks at 10 a.m. Eastern Time. Mike, this was cool. You're going to stick with us.
Yeah,
The inflation data is about 4 minutes away. Going into it, equity futures up by 0.4% on the S&P 500. Yields lower by 4 basis points. Your 10-year, 349.49. Your inflation report. Up next.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
20 seconds away from the inflation data in America. Your market with a bit of a pop higher going into this print. Equity futures up by 5 or 0.6% on the S&P 500. In the bond market on a 2-year, we're down about 2 basis points into the print. On a 10-year, we're down about 4 or 5 basis points. I can tell you we're pop higher briefly on euro dollar, just hitting 108 briefly. Back down again right now with your inflation report. Let's get to Mike McKee. Hey, Mike.
Well, it looks like we are bang on in terms of the forecast for the numbers that come in. The December numbers come in with the headline month-over-month change down 0.1% as forecast. The core up 0.3 as forecast, and that pushes the annual rates to 6.5% for headline, 5.7% for the CPI ex food and energy. Doing the calculations here and see if I can get that housing one. I haven't got it yet, but we'll get it for you as soon as we can. The idea, the J. Powell number that everybody is looking for. Taking a look at the percent changes, it looks like food was up 0.3, which is a bit of a surprise. There was it's down from 0.5 the month before, but there was a thought that that might go down a little bit further. Energy down 4.5%. Will Kennedy just left and took his gasoline prices with him. They were down 9.4% in the month of December. So if you were driving, you noticed that. Natural gas was up 0.3, which is kind of interesting. That's the opposite of what we had been seeing. Used cars down 2.5%. That's always a big contributor to this. Apparel prices were up 0.5%, which a bit surprising. And then the housing numbers in terms of shelter up 0.8%, which is 0.2 higher than it was the month of November. So that is an issue for the Fed, and we are just going to have to wait just a second and try to get the updated math done here on the
John, why don't you do the markets while McKee does the updated math?
Well, let Mike work that out. I can tell you how the market's responding to it. Initially lower in the equity market by about 1/3, responding as if it was looking for a bit of a downside surprise on inflation and didn't get one. But these are early days. We're only 2 minutes into this. We've got to look over all the numbers. Yeah. At the front end of the curve, yields are higher by 5 basis points on a 2-year to about 4.27. On a 10-year right now, up about a basis point to 3.55. We did see briefly going into the print, euro dollar, have a look at 108. New high of the session, 108.10. I can tell you euro dollar now negative just on the day, Tom, by about 0.1%, and now not even that.
There was a play a little bit across equities, bonds, currencies, commodities towards a more what I'd call benign statistic, and instead we didn't get gloom, but we got spot-on statistics. We haven't seen the revisions yet. Maybe Mike has them, but I'd also note, John, beneath the radar, it is claims Thursday, and jobless claims are just stunning 2 weeks in a row. They're not as important as inflation, but this is a low number. Is a fully employed America is a non-McKee generalization. He would never say that, but there it is. And
I'm employed, which counts as fully employed.
For you, Mike,
205,000 for initial jobless claims after 206 last week, but these are also still holiday adjusted, so we kind of give with a grain of salt, but it doesn't suggest any problem.
Do you have this
in the labor market
statistic?
We don't have the total. We don't have the accurate one, the one that I want to use yet.
Okay.
But we do have the calculation that the BLS makes of less food, shelter, and energy, and it was down on the month by a 0.1% after a 0.1% drop last month. So it looks like no change, still going down without housing. The difference is the BLS number includes lodging away from home, including hotels and things like that. And most economists think that Jay Powell is not talking about that. He's talking about rent and home prices.
25 for the Fed now, early February?
No reason to think that they wouldn't at this point. Most of them have been saying we want to get to 5%, but they haven't said we need to go as fast as we did before.
Tap on the back for Wall Street. Just a little bit of a pat on the back, Tom. Bang in line with estimates, this number. Mike McKee, thank you. Looking at the price action right now, equities down just 0.1%. As I keep saying, early days will take some time to process this. The yields are higher by a basis point at the front end, not a major move. 4.23 in the FX market. Euro dollar now punching back towards 108. So there you go. The FX market all over the place around this print in the last couple of minutes. 108 at the moment on euro dollar, positive 0.4. If you're just tuning in, the data as follows. Headline year-over-year CPI drops to 6.5 from 7.1. Bang in line with estimates. A lot of people very focused on month-over-month core. Strip out food, energy over the last month, 0.3. bang in line with estimates, Tom, at 0.3 and up from 0.2 in the previous month.
Long ago and far away, and we'll have Mike drop in here as he gets more information, particularly on those key ratios. Long ago and far away, we used to worry about what sandwich Chairman Greenspan was carrying into the Fed meetings or maybe into the inflation report. Vincent Reinhart is expert at that. Vincent Reinhart is with Dreyfus and Mellon and, of course, led all of our economic research at the Fed during the Greenspan years. Vince, just perfect to speak to you this morning. Thank you for joining. This micro-analysis of data post-pandemic, have you ever seen anything like it?
You mentioned Alan Greenspan, and he loved getting into the details of the data. So, the fact is, the Federal Reserve Board building is pretty big, and it's stock full of economists, and they look into the details of all these reports. I think that the Fed, Chair Powell, has been extremely transparent about a very specific mechanism about inflation, the super core, or the Powell's power core, really getting down into the third level of detail.
I want to make clear, John, we need to continue to look at these markets. They're narrow moves, but nevertheless, we were green on the screen with a real plunge down. And John, just as Mr. Reinhart gives us wisdom, boom, we come right back in the equity space.
Interesting to see the FX moves as well. That's a 2% move on dollar yen, Tom, which I think is what you were looking for.
Yes, thank you. I missed that.
Move.
We're now below 130.
It's a break of 130.
Stronger yen there, and a euro dollar 108. We'll continue to look at those major pairs here with Vincent Reinhart as Mike McKee dives deeper into the CPI report. Vince Reinhart, is this inflation completely pandemic induced, or do we have issues that harken back to when your lapels were wider?
So I never wore that wide lapels, Tom, but I think the answer is, why is Jay Powell going into the details? Because it's the mechanics of inflation that has them worried. Inflation is embedded in the persistent part of the basket that households consume, that services less shelter, that Mike keeps mentioning, that Jay Powell keeps mentioning, that shows up in all those speeches. And in some sense, yes, we got an inflation report exactly as we expected. We also got a reminder that the labor market is running pretty hot. From the Fed's perspective, aggregate demand has momentum. That's putting pressure on resources. That will put pressure on wages and therefore on prices. Maybe not this month on prices or wages, but the mechanics are there. The mechanism that you worry about inertial inflation is there.
Reinhart and Orphanides and others from another time looking at the long term. We'll continue with Vincent Reinhart of Dreyfus and Mellon looking at the micro short term as Michael McKee. You're diving into the pages and pages of data, Michael. What do you see?
Yeah, looking at the core services X housing, which, as I mentioned, you take out the owner's equivalent rent and rent of shelter, and it is up by basically 25 basis points, which is a little bit higher than that BLS number that we gave earlier. Rent of shelter rose 0.8, which is more than last month, and it rose 0.8 in terms of primary residence, which is the same as last month. And then owner's equivalent rent up 0.8. A tick higher than the prior month. So we're still seeing the impact of higher home prices and higher rents in the CPI report, which is what Jay Powell's trying to take out so they can get a cleaner read on where core inflation is.
The dollar weakness, the market story of the day, without a doubt. Equity futures just about unchanged on the S&P 500. In the bond market, you've got this drop away, just falling away now at the front end of the curve again. We're down 5 basis points on a 2-year to 4.17. They're looking to hike again over at the Federal Reserve. This 2-year keeps on rallying. Your 2-year, 10-year spread still about 66 basis points, so no real drama there. But in the FX market, Here's the move for you on dollar yen. Dollar yen briefly breaking through 130 with some yen strength. That was a 2% move. It's now a 1.7% move. And I can tell you, just before the print and after the print, euro dollar had a look at 108. Now back, Tom, to 107.73.
I'd also look at Mexico with some Mexican strength and renminbi to 4 digits, 6.7375 strong yuan as well. Vincent Reinhardt with us and thrilled he could join this morning. Vincent, is there an underlying theory at the Fed, or are they literally making it up as they go? Is there Oken? Is there Phillips? Is there Taylor? Is there Reinhardt? Or are they flying blind?
They're doing the best they can, and it's actually pretty conventional. Inflation has a number of parts to it. John Williams talks about the inflation onion. We've gotten the good news on the outer shells. Commodity prices off, energy prices in particular off a lot. Next shell in, goods prices are doing better because supply chains have mended, market economies work and shift resources around. They're worried about the core. They're worried about the inertial part of inflation that is importantly gets embedded into contracts that are written at different times. And so it's a slow slog in which inflation has built, and they're worried it's going to take a while for it to come down. So, yes, I think markets got what they expected, even though they were hoping for good, even better news. Don't try to get between a rally and reality. But the reality is, Ed's looking at the details, and the details are supportive of 2 of the 3 planks to the story they rely on.
Hey, Vince, this was great.
Momentum, slack, maybe not so much right now, wages and prices, but the other 2 things are the reason you worry about future wages and prices.
Vincent Reinhardt there of Dreyfus and Manor. Hey, thank you, Vince, as always. Equities down about 0.1%. No real drama here into the bond market. Bit of a rally at the front end. Yields lower there by 3 or 4 basis points. Just putting a little bit more pressure on the US dollar. Coming up in the next hour, Jim Bianco of Bianco Research on some of these moves and what it means for the Fed. Priya Misra of TD. TK will throw some LIBOR in there for you, okay?
Please do.
And Jonathan Golub, Credit Suisse. Next stop for this market. Earnings tomorrow morning.
Yeah, which matters. I'm sorry, Mike Wilson's nailed this at Morgan Stanley. This time, it really matters.
We'll see. Hey, Mike, that was great. Thank you, Mike. Appreciate it. Mike McKee's going to join us at the top of the hour.
I'll stay with Tom, too.
You're going to stick around with Tom?
Yeah.
That's kind of you. Okay, I'll see you in about 20 minutes.
Okay.
Hey, Tom, that was great.
Yeah.
A lot of people messaged me this morning, wanted to know what was in that tank a little bit earlier on.
Oh, yeah.
I send you the corks from New York. This is Bloomberg.
Swiss aperitif.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, fierce fighting is raging in a town in the Donetsk region. Ukrainian military officials say that Russian attempts to capture Soledar are failing. It's located just 6 miles from the strategic city of Bakhmut, and capturing Soledar would be a symbolic victory for Moscow after a number of defeats. The U.S. and Japan are taking steps to counter the growing challenge posed by China and its ties with Russia. They announced plans to strengthen defense cooperation on land, at sea, and in space. The U.S. plans to reorganize its forces in Japan so it can deter and respond better to increasing regional threats. More than 7,000 striking nurses at 2 New York City hospitals will return to work today after reaching a tentative deal. Union leaders say the workers at Montefiore Medical Center and Mount Sinai Hospital will see pay raises and improved working conditions. The strike began Monday morning after 4 months of contract negotiations fell through. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This
is Count Under the Close. Welcome to Bloomberg Crypto.
Bloomberg surveillance, an eventful morning to say the least. Lisa Bramlett and John Farrow, Tom Keene with you. Lisa on assignment, Farrow getting ready for the 9 o'clock show. Thrilled you're with us on radio and television. And thrilled Michael McKee's with us because the engineer from Wharton, one of the people I lean over and I really listen to, Mr. Harker of Philadelphia. Michael McKee, Harker Speaks.
Yeah, Pat Harker giving an economic outlook this morning up in Philadelphia. And basically, this was before the CPI came out, but he said he sees signs of inflation cooling, and he thinks the 25 basis point moves will be appropriate from now on. And he is a voter this year. So he's already in that camp, and the numbers come out, Tom, as expected, with inflation continuing to fall. So no reason to think that he would go back on that. He also says he does not expect a recession, but I don't think you'd ever get a Fed official to say we're going to have a recession.
They're not going to say, but 1% GDP is not in the zeitgeist right now. Am I right? Still, the zeitgeist is gloomy as it was 4 weeks ago.
Well, it's starting to come up a little bit, and you've noticed some people beginning to talk about the soft landing possibility because the data have come in stronger than expected for the most part, and so that's possible. The Fed had forecast 0.5% growth this year. Now it's up to 1%.
An adult like you, are you looking to February 1, or are you already cheating and going out to what I believe is March 22?
Well, I think we go out to March in terms of the major question for the markets going forward because, if we've got Harker at 25 basis points, and we heard from Susan Collins yesterday, 25 basis points, I think you're looking at a Fed that's going to be committed to a lower rate increase. And then the question is, do they go beyond that? Do they continue to raise rates, and then do they continue a 25 basis point move? That'll be the argument for the markets as we collect data between now and March.
Michael McKee, thank you so much. Much more from Mr. McKee through the morning here as he dives into the pace of inflation in America. We're going to segue right now with red and green on the screen. The VIX has come in sharply, 20.24, an important statistic there on an S&P that printed 4,000 earlier. And we are privileged for a repeat performance from Dana Telsey's Chief Executive Officer and also of research at Telsey Advisory Group on the pulse of American retail. I've got to go to the gossip of the moment. And I'm going to say this with respect. Richest guy in the world, a guy that took Louis Vuitton and figured out how to do luxury fashion. There's nepotism involved here. How do you address, as one of the most grizzled veterans on the street, when it is about relationships, if it's Prada and relationships, or it's LVMH with his daughter coming over to run Dior, is that a plus or a minus?
Right now it's a plus, and the reason why,
These aren't new people going into those business lines. She's been involved in Dior. She's been there 20 years. So you're getting experience, and you have to say the succession planning. But look at the depth of talent underneath her, and frankly, in each of the brands. What they have with 75 brands at LVMH, they have the experiential talent to move everyone up the line, and that's what they do.
These have log convexity. These luxury groups off China opening and the rest, you predicted this with your team. They're a moonshot right now. Can you acquire shares this morning in these heritage luxury brands?
You can, because the next development will be the reopening in China and that China consumer. We've already heard from others. I mean, you look at what Neiman Marcus most recently said about the strength of the holiday season, and you're seeing the product innovation driving demand.
Right.
So I think it's going to be a good season, but let's keep in mind, we're still having consumers in all areas with the volatility of the market. There's been a step down in terms of what the rate of growth is compared to last year and even in 2021.
So one more question on luxury. Can you overweight luxury now? Is the market is overweighting luxury?
I don't think the market's overweighting luxury yet.
Really? With the moonshots we're seeing in some of these stocks?
I think there's more opportunity when the holiday sales come in, because also the ability to drive strength out of China, that's going to be the next
single best buy now in luxury, particularly when you look to China. What's your single best buy right now?
I mean, it's LVMH in the international, it's Tapestry in the domestic. And the other one, Ralph Lauren. Ralph Lauren has a significant opportunity.
We'll go to that in a moment. I mean, you're killing me. You know how much I hate this phrase. This is Coach, right?
Right, yes. But it's Coach, it's Stuart Weitzman, and it's Kate Spade. And what they've been able to do in resetting prices, updating the brands, capturing the younger customer base.
They had a home run in the Tom Wesselman. They did the Tom Wesselman thing. Is that where we're going, where these brands come in and they get famous celebrities and artists, like they'll do a Dana Telsey coat or something like that?
I don't know about that. It's collaborations. They matter. Collaborations drive demand. And you know why?
Right.
They go viral on social media. Everyone sees them, and there you go. Sell-through happens.
Does social media help Macy's move forward, or the big boxes that Joe Feldman looks at?
Yeah, it does. I mean, we just had a dinner with Macy's the other night. The personalization and pricing science that's being allocated to their merchandising is really helping them navigate a consumer environment that's definitely a bit more challenging for the income level of the Macy's consumer.
How do they manage expenses? At that dinner, do they talk about the cost rationalization of suburban malls that are off the mark?
Well, not only that, but what about the Bed Bath & Beyond stores that could come up for play, and there's a healthy demand, even in Marketplace by Macy's, or the off-pricers want those boxes. Those are good boxes in great locations.
For the same concept?
For Macy's, it's a different concept. It's a smaller Marketplace by Macy's concept that they put in there. But let's see what develops with these Bed Bath & Beyond locations.
My recollection is Telsey Advisor Group avoided the carnage of Bed Bath & Beyond. Let's be constructive. Why did they fail? What's the best practice forward for retail not to do a Bed Bath & Beyond?
You need branded merchandise under a need to be able to continue to innovate the offering, and yet Home Goods out there taking share, and you didn't play up what made Bed Bath & Beyond so special. Go in there and buy more than you originally expected.
Got to lift to the market the VIX and a stick here with Dana Telsey, a Telsey Advisory Group, watching this carefully. Less curve inversion than what we saw off the CPI report. Dana, I've got to wrap up with the guy who is iconic. Ralph is Ralph. Does he have nepotism in play like Mr. Arnault, or does he have a succession plan? He's a bit ancient.
I think overall, look at the team that you have there now with Patrice Louvet and Jane Nielsen, CEO and COO. They're taking the brand to the next level and modernizing it, and it's showing up in the numbers and the AUR, and consumers are reacting.
One question, single best buy right now for Telsey Advisory Group across all your team?
I mean, we have a bunch of names that
Amazon?
we're interested in. Joe likes Amazon. It's been a favorite name of his. But also, let's take a look at what some of these off-pricers are doing. I mean, the TJX, certainly we're watching. I would say that you look at Abercrombie & Fitch, and it's exciting.
Really?
Ralph Lauren, yes.
Do you know that Michael McKee almost was a model at Abercrombie & Fitch years ago on Fifth Avenue?
Well, you know, it's a different store today than it was then.
Yeah, but I would have been in the pith helmet.
Everyone knows this brand. They're getting resurrected again. How's Abercrombie & Fitch going to do it? What's the pixie dust this time?
The pixie dust this time is the Abercrombie & Fitch brand has aged up. It's better quality.
Aged up.
Yep, it's not the teens. And Hollister is showing some improvement in their assortment and getting the men's business too.
Dana Telsey, thank you so much. We're going to age up now and continue with Keenan McKee as we age up. Tell me about the ageless comments from Harkin and also, Mike, what you see in this historic inflation report.
Well, Pat Harker is joining a crowd that says 25 basis points, and the numbers today justify that with a 1/10 drop on a month-over-month basis in December, pushes the headline number down to 6.5%. So on the path to where the Fed wants it to be. Interesting thought here with Dana here is I'm looking at apparel costs, and everybody thought maybe we'd see a discount on that, but they're up 0.5% because men's clothes went up. Almost all of women's clothes fell. Men's and boys went up.
So the interesting thing there, company after company I spoke to over the past 3 days, men's is showing improvement, and all the retailers, inventory levels are coming down faster than expected, and that's going to be a good thing.
They told Tom he needs a new suit. The interesting thing is men's and women's shoes.
A bow tie.
Yeah, men's and women's shoes.
This bow tie is over 20 years old.
That's why.
That's the problem. I look, to wrap this up, Dana, I'm so sorry. I've got to go to Mike here as we drive forward into the Bloomberg morning. Mike, are we going to have the same inflation frenzy 30 days from now?
Sure.
I mean, this is
because it's all about inflation for the Fed, and the Fed's going to keep going or at least hold until they are convinced that inflation's going down to 2%, and we don't know what it's going to take to convince them.
John emails in from Manhattan. He says, ask Dana about when Tiffany opens. That's like soon, right? Like a couple months here?
Should be second half of 2023, brings more traffic to the whole area, has a restaurant in the business, in the store too. It's going to make 57th Street very exciting.
Look what they did to the prices of Schlumberger and that at Tiffany. Are you kidding me? The Arnauds are nuts.
I think they walk around saying, take the price up, it'll create demand.
That's good. Dana Telsey, thank you so much. Our economic report from Telsey Advisory Group today. Please stay with us. Markets all over the place. They lift. Futures up 20. Good morning.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
So now you've been at JP Morgan for about 25 years?
Yes.
Okay, so, and now you run one of the most important parts of JP Morgan, which is, I say, is the asset and wealth management business. What actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. The asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stocks, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. Yields drop, stocks pop, inflation data in America showing some signs of cooling. Equity futures of 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
From New York, we begin with the big issue. No fireworks here. Inflation data in America cooling once again, putting even more pressure on the US dollar as the Fed begins to lean towards a smaller move.
Inflation.
The CPI report.
The December CPI report.
There's a lot of hype for this number.
We, like the rest of the market, have no choice but to follow what Powell is focused on.
It's the beginning of the year. It's the last inflation print before the Fed meeting.
The economic models will tell you that we need demand destruction to get inflation to come down.
So really it's the labor market that almost matters more than today's inflation report.
In other words, we need a much higher unemployment rate.
The Fed is now focused on the sliver of CPI that is wage sensitive.
Powell's been very focused on wages.
Get rid of anything that's not attached to wages.
But the problem is, maybe inflation today is not driven by demand.
At this point, it's a lot more noisy.
For more, let's get to Mike McKee. Mike McKee, your read on things 30 minutes after that report.
Well, steady as she goes, the progress continues on inflation. There are a few hiccups here and there, but overall, it looks like the Fed can dial back its rate increases and start to think about when they might pause. The numbers come in bang on expectations, down 0.1% on the headline, up 0.3 on the core. Food prices up but decelerating. Gasoline prices fell off a cliff during the month. Apparel prices were surprisingly up a little bit, but we were just talking with Dana Telsey about that, and she said that's because men's clothes are selling better. Used cars down almost the same as the prior month. So some of the categories that had pushed inflation higher over the last year really starting to back off now, and that's true in the goods area. You can see goods prices are continuing to deflate, down 0.5% from the 0.8 in November. Services prices, though, still going up, so that makes us look at the core services ex-housing number, Jay Powell's number, and that was up 0.3% in December compared to 0.1%, taking out rent and owner's equivalent rent. And that's a number that matters to the Fed because they know home prices are not rising anymore, but it still shows up that way in the CPI. So the question becomes, what does the Fed do from here? They were slow to react to inflation going up. Now are they going to be slow to react to inflation coming down? That's an open question at this point, although we do have Pat Harker from the Philadelphia Fed this morning saying he's ready for 25 basis points instead of 50. And Susan Collins said the other day she is too. We'll see who else joins that parade today. I think, John, one of the key numbers, and I just got this in from Omer Sharif of Inflation Insights, is if you look at it on a 3-month basis, the core CPI is 3.1%, and the 6-month is 4.5%. So we're really seeing a decline in sequential inflation that is taking hold here. You got to get rid of those base effects, and you're really seeing some movement, and so the Fed's going to be thinking about this now.
And Mike, it's happening with unemployment at 3.5% still.
Yeah, we could mention very quickly that we only had 205,000 initial jobless claims.
It's impressive.
Distorted by the holidays, but certainly no indication that we're losing a lot of people.
Mike McKee, thank you, sir. Counting you down to that opening bell, about 25 minutes away, 26 minutes away. Equity futures are higher by 0.7%. Seen a rally come into the front end of the bond market. of the yield curve, down 10 basis points on a 2-year, 4.12% now on a 2-year, on a 10-year down 7 basis points to 347, and we're seeing a ton of dollar weakness as well. Euro dollar reclaiming a 108 handle, 108.22, euro dollar positive by 0.6%. With us now, I'm pleased to say, TD's Priya Misra, Jim Bianco of Bianco Research. Priya, first to you, your first take on this one.
Sure. So I think there were some positives in the form of this. Inflation has clearly peaked. I think we're seeing goods inflation continuing to decline. What I'm a little surprised by the market reaction is that the service inflation, so service CPIs, shelter inflation, core services ex shelter, that's still high. It's actually accelerated over the last couple of months. I think if you take the Fed at face value, that's what they care about. I think the easy part of the decline in inflation may be underway. Goods inflation's declining, commodity prices are falling. The much harder part is getting that service inflation down consistent to 2%. I think the market thinks that, they can extrapolate this trend and that the Fed has maybe 1 or 2 more 25 basis point hikes. I think the Fed may have to actually continue to hike. So our call is 5.5 for that terminal rate. We're calling for a 50 in February. I mean, maybe that's a 25, but I think the Fed's going to say we're not done. I think the market's a little too optimistic, extrapolating that this decline in service inflation will continue. And historically, service inflation is very sticky on the way down.
Jim Bianco, are you on the other side of that argument?
Not really. I think that what the market should be focusing on as we go forward from here is where do we go next? Okay, inflation peaked, 9% was the high. That's the easy call. It's very obvious that that's happened. Are we going to 2% without any kind of intervention like a recession or anything else to dampen demand to get us down there? Or, as Mike McKee just pointed out, do we bottom out somewhere around 3 or 4%, the 3 and 6 month averages that we've seen? Is that where we bottom? Because if that's where we bottom, that will be unacceptable for the Fed, and that they will not be looking to pivot, or they won't be looking to slow down the rate hikes. Yes, they'll move 25 basis points in February. That has been priced in for a month now, that it would be a 25 basis point move, and maybe 25 basis points after that. But I think the narrative and the attention should turn to how far down are we going to go, not has inflation peaked.
This is what Sarah House of Wells Fargo is getting at as well. She says we're approaching this last mile, this big effort, and that last mile will be the hardest mile. Priya, you've made the same point. Just how much demand destruction you still think we need to get inflation to where the Fed wants to see it?
So I think we need a lot more demand destruction, particularly in the labor market. I think businesses are hoarding labor. Wages did come down a little bit last week, but you still look at year-over-year wages well north of 4.5%, not consistent with 2% inflation. I would also argue the lags point, the long and variable lags. The Fed is looking at data right now, and that data on the labor market does not suggest that demand destruction. How forward-looking can the Fed be to say that we think this demand destruction will happen in the labor market 6 months out? I think if you take them at face value, they are saying they're responding to data as it comes in. So, our view is they are going to be late. And I think the market is cheering. We're pricing in more rate cuts at the end of this year, more cuts next year. I think that is a mistake because the Fed is telling us they're worried about the mistake of the 70s. They really want to see that 2% inflation. And my views are there are structural forces that's going to keep inflation high. Until the Fed accepts that and is perhaps okay with a 3% inflation, they're going to be really reluctant to, I would even argue, stop hiking, let alone start to cut rates. So this optimism why the 2 years falling is all these cuts getting priced in. I think that can get taken out as we hear from the Fed that they can stop at, maybe it's 5.25 or 5.5, and then they're going to just stay there for a very long time while that demand destruction that you talk about is an intended consequence of policy, and they have to see that through. And I think the market's already looking ahead to when can that easing happen. I think we'll be waiting for quite some time for that.
Priya, you mentioned what's happening right now. Neil Dutter of Renmark is pushing back against all these recession calls and talking about what he thinks is happening right now. Financial conditions are now easing and have been for a couple of months, supporting economic growth right now. Instead of long and variable, I think the lags are short and predictable. Jim Bianco, your thoughts on that? The fact that some people think we're actually seeing a re-acceleration in the U.S. economy.
There's plenty of evidence to suggest that initial claims this morning at 205,000, and there really isn't a lot of evidence that the economy is slowing. When Priya says we need to see more demand destruction in labor. I want to say we need to see any demand destruction in labor right now, because 3.5% unemployment, 205,000 in initial claims, and still printing 200,000+ for payrolls every month. That's not demand destruction at all. And if those numbers continue to move forward from here, it's going to be hard to bring that wage inflation down, which is at 4.5%, I think much below 3.5% or 3%. And according to Powell's, services ex housing, you're not going to see inflation, dip into a 2 handle without that demand destruction. And if we don't get it, then we're going to have to pivot that narrative, as I was talking about earlier, to not just that inflation is peaked, but how do we get to 2% without a recession? And if we come out of a recession, does inflation just bounce right back up above 2%? And that's an uncomfortable question for Wall Street right now.
Mike McKee mentioned Patrick Harker a few minutes ago, leaning towards a 25 basis point hike over at the Philly Fed. He says this, though, in response to some questions in the Q&A, favors rising rates a bit above 5% and then pausing. Now, to your point, Priya, if we take the Fed at face value, they're not cutting interest rates. But I think the problem at the moment, Priya, is that I can't find many people that are taking the Fed at face value. Can you?
I think when you listen to the Fed, all they can sort of tell us is the reaction function. So maybe the markets understood their reaction function. I think where the debate in the market is the economic outlook. I think the market is a lot more optimistic than the Fed in terms of how quickly that inflation will decline. Look at the TIPS market. Market's pricing in 1-year inflation at 2%. I mean, we're talking about will it settle at 3%? As a good thing, but the market's pricing in well below that. So I think the market pricing in these cuts is not so much second guessing the Fed reaction function. It's saying that the economy might be much weaker, that inflation might be much weaker, and so the Fed will have the ability to cut rates because inflation is back down. I think the uncomfortable question, to Jim's point, is what if inflation does settle at 3%? Then I think the Fed is telling us very clearly that they need a much higher rise in the unemployment rate, closer to, I would say, 5%, which we're very far from, before they can respond. So it's really this tension of what is the economic outlook? The Fed has one view, and I think the market is saying, oh no, inflation's now headed down. Just as we couldn't quite forecast how quickly it would rise, I think the market's saying, we've all gotten it wrong. Inflation is going to decline much faster. And I think that might be the disconnect, why the market is so much below the Fed dots.
Well, there's another dynamic we need to discuss as well. And Jim Bianco, that's China reopening. How much does that complicate the outlook?
Oh, I think it complicates the outlook a lot, because while China is reopening, zero COVID is gone, the mobility numbers are showing, like the transit numbers, that people are getting out of their house and finally moving around. What does that mean? Wall Street wants to think that means, 2019 is coming back. Everybody's going to return to the factory and we're going to make iPhones just like nothing happened in the last 2 years. Or does it mean in China, like it's meant in the West, that while we got out of the house and we started moving around, there were fundamental changes to the economy in the West, work from home, remote work being the biggest one that we're all familiar with. Does China experience some kind of a fundamental change so that just penciling in a return to 2019 growth rates and 2019 production rates because zero COVID has been lifted might be a little bit premature? Yeah, they're going to reopen, but we don't know what the composition of that's going to look like, and that does complicate things.
Have you got a base case yet, Jim, or is it still too early?
I think it's still too early, but if I had a base case, it would probably be that the production numbers that everybody's expecting, really what Wall Street is expecting is raw material prices are going to rise because China, the factory of the world, is going to suck everything in, whether it's industrial metals to energy, push up those prices. Out the backside is going to be a bunch of finished goods, which is going to help to further depress core inflation. That's been the narrative for the last few months. I think that probably the first half is going to unfold, but the second half, as far as the massive amount of finished goods, because if China's listening to everybody else, where the world's going into a recession, they're not going to be ready to really crank up production as hard as we think or hope that they are, that might disappoint a little bit as we move forward.
Great. Just a final word on China, please.
So one of the things I'm watching is on the stimulus front. I mean, if China's opened up, how much are policymakers there going to put in terms of fiscal stimulus, credit easing? Remember 2015, massive amounts of credit easing then was a global growth positive. our view is it's going to be more targeted. It's going to be more domestic leaning as opposed to a global growth surge. But I'm certainly watching those credit numbers. And if that starts to ramp up, I think it takes a big tail risk for the economy out. And that can explain why, we're talking about a recession and yet financial conditions are easing. Well, because China is going to be this growth engine due to easing. I think it's still early. We're watching both fiscal as well as credit easing measures in China to see what the global growth outlook, what China growth outlook will be beyond just what's happening in the US, which I think a slowdown is at this point in our view, we have a recession baked in for the second half of this year.
Prime Minister Jim Bianco sticking with us. Equity futures right now fading just a little bit, still positive by 0.2% into the bond market where we have got this rally at the front end of the curve, rally right the way through the curve, but particularly on the 2-year. We're down about 7 basis points on the 2-year to about 4.15 in the FX market. Some dollar weakness for you. Euro dollar just in and around 1.08. Coming up, another cooler inflation print for DC.
We got an inflation report exactly as we expected. We also got a reminder that the labor market is running pretty hot.
The View from Washington up next.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Yes, we got an inflation report exactly as we expected. We also got a reminder that the labor market is running pretty hot. Aggregate demand has momentum. That's putting pressure on resources. That will put pressure on wages and therefore on prices. Maybe not this month on prices or wages, but the mechanics are there. The mechanism that you worry about inertial inflation is there.
A little bit of good news for the Biden administration as the nation sees 3 straight months of cooling inflation. The president preparing to deliver remarks at the top of the hour. This coming as the controversy over classified documents continues to unfold in Washington. Bloomberg's Anne-Marie joins us now from the White House. Morning, AMH.
Good morning, John. That's right. The president is likely going to seize on these numbers, especially the month-on-month decline. And so much of that was driven by the drop of gasoline prices, when just a few months ago, this was the biggest political headache facing this administration, especially heading into those midterm elections. And now they can really breathe a sigh of relief of where gasoline prices are going. But we should note he cannot claim victory too quickly. One, on gasoline prices, because whether it's Pierre Onderon or Will Kennedy in the last hour with you and Tom talking about oil prices, they are expected to go up. So potentially it's too quick to really claim that victory on where gasoline prices are going in the future. And there's also other factors in this CPI report, like shelter, like recreation, like clothing, that is going up. But overall, this is a good sign for this administration.
Can you tell me what the plan is to refill the SPR, Anne-Marie, and how much the China reopening complicates that effort?
Well, now that you see prices much higher, Jonathan, it's going to be incredibly difficult for the administration to refill the SPR. They want it really below $70 a barrel, and we are already above that. And when you have Pierre Onderon, when you have Jeff Curry talking about prices north of $100, that is not going to mean a refill of the SPR anytime soon. And China obviously is the biggest question mark on this in terms of how higher oil prices will go, and then thus gasoline prices, because if we have a quick and clean reopening of China and they start consuming a lot more, and you can see the trend of just automobiles on the streets in Beijing and Shanghai start ticking up higher, then that's going to mean higher oil prices and less of a fact that the U.S. is likely going to want to refill that SPR anytime soon.
AMH, thank you. Down at the White House, we'll hear from the President of the United States in about 40 minutes' time, scheduled to speak at 10 a.m. Eastern Time. Prime Minister Jim Bianco back with us. Jim, I want to talk to you about the fact that we came into this year waiting for this growth slowdown, and all of a sudden people are starting to pile in to long EM equities, long European banks over the last 6 months. The copper trade starting to deliver in a massive way. 9K, Goldman talking up 11.5 maybe at some point this year. Looking at high yield spreads on a screen right now. The wides of last summer were 583. We're at 420. Credit spreads are rallying. Jim Bianco, makes sense of that as we discuss the possibility. Priya's talking about the potential of a recession in the second half.
Well, let's start with the most powerful drug on Wall Street, and that's mean reversion. That when you show a bunch of professional managers markets that are down a lot, their instinct is to bet that they are going to rebound to revert to some kind of a mean. So a lot of what you're seeing, as you mentioned, just to pick one, European banks, European bank stock index is at the same level it was in 1987. There has been no movement in European banks for 35 years. So the 40% rally that we've seen in them since July is more, I think, in the mean reversion camp. So there's a lot of that going on in the market too. Second of all, the narrative on Wall Street has always been a weak first half, strong second half. So to take a word from the recent past, everybody thinks that the weakness is going to be transitory and that it will give way to a second half strength. So look past whatever weakness we see, look past whatever potential recession talk that we've seen, because don't worry, by the third or fourth quarter, we'll be past that. And stocks and supposedly risk markets, as you mentioned, are supposed to be more forward-looking than that.
The consensus is starting to crack pretty quickly. It's only January 12th. We'll see how this shapes up in about a week from now. Priya, just a final word from you on this. This headline across the Bloomberg a few hours ago that you've responded to already, but I'd love your input on. 3-month LIBOR, dollar LIBOR exceeding the 2008 financial crisis high. Priya, I guess my first question to you is just how relevant is that anymore?
It's not relevant. I mean, there are very few new contracts actually do not take LIBOR. The existing contracts, LIBOR is going away in now less than 6 months. They're all going to move to SOFR. So I would say it doesn't matter. What it does show is bank funding costs are going up. I mean, the banks are having to pay more to keep deposits. They've been losing a lot of deposits as Fed fund rates have been rising. You know, are banks raising money in the wholesale market? I think the general trend, why it moved today, I think is not obvious. But, you know, there's a process how that LIBOR is computed. It's still a floating rate index. It's going to go away. So I think it doesn't matter. But it does reflect that bank funding costs are going up. NIMs are under pressure. If the Fed keeps hiking, I think you'll continue to see these funding costs for banks continue to rise. I think that's what it's reflecting, but it shouldn't be a worry for anyone. That index itself is going away.
Tomorrow morning, JP Morgan, BofA will be focused on that. Priya, thank you. Priya Misra there and Jim Bianco. Priya with some big calls, looking for 550 on Fed funds later this year and potentially a recession as well. Inflation data in America, bang in line with estimates. Equity futures positive by just 0.1% on the S&P. The Nasdaq now slightly negative. That rally in the bond market fades a little bit, still low at the front end. Yields down by 6 basis points on a 2-year to 4.15. If you look at the FX market, That dollar weakness has started to come through recently. Euro dollar had a look at 108. Dollar yen had a look at 129. Euro dollar right now 107.98. More on that in just a moment. Coming up in the morning calls and later, big banks kicking off earnings season tomorrow. Jonathan Gollop at Credit Suisse expecting a 3 to 5% contraction in earnings this year. That conversation coming up shortly.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Four or 5 minutes away from the opening bell, equity futures positive, a 0.25% on the S&P, just about positive on the Nasdaq. That's the price action. Let's get you some morning calls. The first one from Credit Suisse, upgrading Boeing to neutral, pointing to strengthening deliveries and improving operations. Wedbush downgrading Advanced Auto Parts to neutral, growing more concerned about the company's spending and crowded inventories. And finally, Jefferies upgrading Netflix to buy, 385 price target, expecting margins to surprise to the upside next year. That stock's up by 1.3%. Coming up, counting down to earnings season, Jonathan Gollop at Credit Suisse seeing room for some upside surprises this quarter. Jonathan Gollop up next, your opening bell, coming up shortly.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Part of what I love about business is you get to build things from nothing. I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
24 seconds away from the opening bow this morning. Good morning. This Thursday morning, CPI data's come out bang in line with expectations. Equity futures off the back of it, just about positive by 0.2%. Putting together 2 days of gains coming into Thursday. Can we make it 3 on the S&P? That's your opening bow. Switch to the board and get to the bond market. Yields shaking up as follows on a 10-year yield in America. Down 3 or 4 basis points, sub 350 a little bit earlier this morning. 350.41 right now. The high of last year, the 10-year peaked at 433 back in October. We're well below that level now by more than 80 basis points. In the FX market, euro dollar, hello, 108, 108.19, 108.20 on euro dollar, up 0.6%. This dollar weakness that's kicking in is real. And we're going to pick up on that story in just a moment. Crude right now approaching 79 on WTI, up by 2 percentage points on the session. That's the cross-asset price action. About 30 seconds into this one, we advance about 1/3 of 1% on the S&P. On the NASDAQ, up 1/3 of 1% also. One stock to watch at the open, it's Disney, the company facing a proxy war with activist investor Nelson Peltz. For more on that, here's Abby.
Hey, John. Well, yeah, it looks like it's going to be a battle. And with the stock higher right now, up more than 2%, it suggests some shareholders and at least one analyst on Wall Street agree with Nelson Peltz's view. Now, they, of course, did this morning, Treon Management, file a preliminary proxy statement urging shareholders, other shareholders, to support his nomination to the board. Some of those other shareholders, Vanguard, BlackRock, State Farm, Newport, Royal Bank. Now, currently, Treon Management has a roughly $900 million stake. That would put them right around 22 or 23. So a pretty big shareholder there. And they are criticizing a number of factors right now. First and foremost, they really want a Bob Iger succession plan put in place. They're also talking about excessive compensation and the fact that the company has perhaps overpaid for some assets, including some of those 20th Century Fox Media assets. Now, relative to paying for them, the debt is high. This could be another issue. Right now, Disney's long-term debt about $49 billion. So relative to the stock, though, this is another issue brought up in that preliminary proxy statement. Since its peak, it is down, and this came as a surprise to me. It's down 50%. I mean, it's a really pretty incredible decline at this point, so it's going to be interesting to see how this plays out. And Nelson Peltz is known for having won some of these proxy wars in the past. They're not for the faint of heart, and it'll be interesting to see whether or not he convinces other shareholders to allow him to be nominated to the board.
Brutal 12 months. Abby, thank you. I started the show by saying no fireworks. You want some fireworks? You want some price action? Bed Bath & Beyond. Monster move. Have a look at this. Up by 15%, and have a look over the last 3 days as well. Katie Lyons, explain this, please.
I wish I had a good explanation for why fundamentally this was happening, John, but it has indeed been remarkable. This 15%, actually now 17% gain today would be the smallest we've seen in 4 days, a 4-day period in which we have seen this stock rally 200%. It was up 69% yesterday alone, a record day of gains, and really for no good reason, considering last week this company warned it was maybe going to have to file for bankruptcy. Then we actually got results from it this week that showed a wider loss than expected, the company attributing part of that to its inventory struggles because suppliers have lost trust in the company's ability to make payments. Sales growth also has been floundering. So do fundamentals really support this rally whatsoever, John? The answer is no. Maybe we can attribute some of it to a short squeeze, given that short interest in the stock has been rising and is now about 52% of float. But mostly it just seems like meme trader behavior is making a comeback, because this has extended beyond Bed Bath & Beyond. We've also seen gains in the likes of AMC and GameStop, even Carvana rising as well. So meme stocks as a group actually have had a pretty solid start to 2023, up about 10% so far. That only goes so far, though, to undo the damage that was done to these names last year. That meme ETF down more than 60% in the last 12 months, John.
Bed Bath & Beyond up about 20% right now. Katie, thank you. 3 or 4 minutes in then, about unchanged on the S&P, almost negative now on the Nasdaq by about 0.1%. Some good news for the airlines after a rough couple of weeks. American Airlines beating estimates in its prelim results on robust holiday travel demand. Ed Ludlow, these numbers pretty impressive.
Yeah, they are impressive. If you take the group as a whole, that group of US-listed airlines, they're on track for their 7th straight day of gains, which would be the longest winning streak going back to August of 2020. I like some good news at this time in the week, Jonathan. What's interesting is what the story is here. The EPS range for the fourth quarter, $1.12 to $1.17, almost double what the street was forecasting. Again, these are prelim results from American Airlines, but what they're talking about here in the story is, A, there was demand over the holiday period, which is interesting because we're kind of trying to get a sense of how the consumer is doing right now, but there is some specifics within that, which is these are not big corporate accounts and business travel that is boosting American. It's actually SMEs, small and medium-sized businesses, along with that leisure travel that's boosting the airline. But again, a strong outlook or a strong prelim call for the fourth quarter. Not so much sense, though, of what's happening to start this year.
Abby mentioned the airlines to start the year. The airline stocks are doing great.
Right.
Ed, thank you, buddy, as always. You will hear from the President of the United States, scheduled to speak in about 25 minutes' time. We've had a tweet from the President of the United States just moments ago. The President saying the following: for the 6th month in a row, yearly inflation is down. It might be rising in economies around the world, but it's coming down here, and gas prices, food, and more are following. Of course, there's a political lean here. That adds up to a break for families and proof that my plan is working. You'll hear from more from the President in about 25 minutes, as I say. A 3rd straight month of cooling inflation, then, is what we're focused on here. Jonathan Golub at Credit Suisse turning his focus on what it means for earnings. Inflation coming down means companies lose pricing power. Even though we don't expect a recession this year, we do expect earnings down 3 to 5% in 23 compared to 22. Jonathan Golub joins us right now. So, John, I'll give you the opportunity just to reflect, first of all, on what we heard in the inflation report about 50 minutes ago, an hour ago, and 5 minutes. Your thoughts, sir?
Well, first of all, this was good news that inflation is coming down, but you have to really look under the hood and ask, why is it coming down? And what we saw was that goods prices are basically free falling. We saw in, I think it was February or March, goods price inflation was up 12.3%, and now it's down, I think, 2.1 in this report. And that's because of, we're further away from the heart of the pandemic, and supply chains are opening, and, autos are now more available, and that's very good news. However, service prices have remained sticky. And if you take out the rents, which are considered part of services, if you look at, the plain old vanilla services, it's basically flatlining at a reasonably high level. So there's a little bit of noise, but bottom line, this is really good news overall in terms of the strength of the consumer.
So, John, I think B of A are looking at the same thing you're looking at. The equity strategy team expects margin compression in 23 amid demand uncertainty and a tougher pricing environment. But they said this, and I know you've thought about this, and that's why I want to ask you. They said still inflation wasn't a universal EPS positive. Where can you find that margin improvement in 23, John?
We have earnings coming down this year from, something like 221, 223, something in that range, to 215 without a recession. So we're not doomsdayers on the economy, but we think that margins are going to be under pressure. Margins are relatively high broadly. But here's, if I kind of look at this employment report and see where's the real big issue, is that wage growth right now is advancing faster than overall inflation, which means companies, the wage growth is going to be their expense, and the inflation, which is their pricing power, is coming down. And if companies have to pay out more to employees and have less ability to pass that on, last year was the opposite. Everyone thought the companies were going to get squeezed by higher inflation, and that was the opposite. They got huge pricing power. This year, it's going to be a little bit more challenging, which is why, even though we don't think we have a recession, we think profits are going to be incrementally lower.
John, earnings season starts tomorrow morning. BofA, JP Morgan, next week Morgan Stanley, and we'll hear also from Goldman Sachs as well. Can we just talk more broadly about what you're expecting in earnings season and just where it compares to, say, expectations at the moment? Is the bar low enough for you, and where is the bar lowest?
Well, so there's a couple things that we're going to see this earnings season. Expectations are that earnings will fall 2% relative to the fourth quarter of last year. But if you look at the median company or the typical company, it's actually expecting to see a 3.5% increase. So what that really means is that the really big companies are having a harder time on earnings. And if you're a portfolio manager and you have a whole bunch of stocks in your portfolio, the majority of them are going to beat to the upside overall. So that's going to be one big theme. A second big theme is that tech companies have been a source of downward revisions, meaning that the earnings estimates for tech companies have been falling a ton. And in the last quarter, not only did they fall a ton, but then they missed the lowered estimates. And we actually think that that's going to continue, that tech is in kind of a sour patch, if you will, for several quarters. Now, on the other side, even though energy, the price of oil is down, over the last 3 months or so, and gasoline prices is down over the last 3 months or so, the energy stocks, their earnings, their expectations are ripping. And we think that they'll actually surprise on better numbers. So there's a number of different themes. The headline will be worse, but at a company level, things will be okay.
So, John, let's just build on that. If tech can't regain leadership and last year's winners, energy, can maintain momentum, that's going to leave the index pretty challenged, isn't it?
Yeah, I think, Jonathan, so first of all, well, we see the index from an earnings perspective, we think the numbers are going to be down. But we found, we just did some research on this, that the majority of the years that when earnings are up, the multiple contracts, or when earnings are down, the multiple goes up, as odd as that actually sounds. Last year, the earnings weren't great, but they were okay. And the market was terrible because the earnings came down. I'm saying the multiples, the PEs. So why did the PEs come down? Is because last year, the cost of capital, your 10-year bond yield, started the year at 1.5 and ended the year at 3.9. You had this huge increase in interest rates, and it knocked down the valuations of companies. This year, we think the opposite's going to happen. We've already seen interest rates fall. We're seeing that, even today and yesterday. And that's part of the reason that stocks are off to a good start. It's not because earnings are good. It's because interest rates have rolled down a little bit. People tend to not focus on that.
And with that, John, the dollar's weaker, a whole lot weaker from its peak back at the end of September. Is that going to be a factor this earnings season? It's pretty well understood. We can all see it on the chart. Where's it going to show up?
It's never as big as we make it out to be. Roughly speaking, a 10% move in the dollar is about a 1% move in earnings. So the dollar, as U.S. inflation has been falling, the expectation is the Fed has to do a little bit less, and the dollar weakens on that. That's incrementally good for corporate profits, but maybe that gives you 20 or 30, 40 basis points of earnings. It doesn't really change the overall earnings season, but it does make U.S. companies a little bit more productive, and you may hear some of that in the language from companies, but it really doesn't change the picture that much, Jonathan.
Hey, John, it's good to catch up. Jonathan Golub there, weighing in over at Credit Suisse. Appreciate it, John. As always, buddy, your broader equity market down about a third of 1%, 12 minutes into the session. We move on pretty quickly from CPI. The next stop for this market, of course, is JP Morgan tomorrow, Bank of America earnings. Then on to next week, we'll hear from the likes of Morgan Stanley and Goldman. Then on to the week after that. The week after that, we start to focus on tech, Tesla, Apple. If you want to call Tesla a tech company, I don't know if you do. But Apple in early February is going to be a massive focus, given the weakness we saw at the back end of 22. In the bond market, a rally on a 2-year. Yields lower by 5 basis points. Right now, 416.55. 10-year basically unchanged at 353.54. I mentioned that weakness we're starting to see in the US dollar. You can see it right the way through G10, particularly on the Japanese yen. Dollar yen has had a 1.5% move today off the back of a local report in Japan, suggesting there might be a policy review at the BOJ as soon as next week. And now there are all these calls, particularly from Citi. Tom was talking about that a little bit earlier this morning, that maybe yield curve control gets dropped completely. The Japanese 10-year new threshold, 50 basis points. This market is pushing right up against it. Keep an eye on that one. Coming up on this program, positive signs emerging in the semiconductor place.
It seems that there is a consensus at the moment that the recession is going to be a mild one. Then the impact on the semiconductor sector probably is going to be a mild one as well.
We'll talk chips up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price-wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
At the moment that the recession is going to be a mild one, then the impact on the semiconductor sector probably is going to be a mild one as well. Chip makers like TSMC or Samsung are not really adjusting strongly their capex. This is a war between the leading edge chip manufacturer. They have to be in front of the race, so they keep on spending.
Auto earnings offering a mixed outlook for the industry. Taiwan Semi planning to cut spending, but the CEO striking a more optimistic tone, seeing an end to the chip crunch. It's a similar story for VW. The automaker expecting supply bottlenecks to ease despite sales plunging to an 11-year low. Team coverage starts right now with Bloomberg's Ed Ludlow here in New York alongside Craig Trudeau in London. Ed, what are we learning on the chip front?
Yeah, it's a mixed picture, isn't it, on TSMC? They are cutting capex for a range of $32 billion to $36 billion, down from $36.3 billion in 2022. They're talking about a decrease in sales in the first half of the year and slight growth in the second half of the year, netting out at slight growth overall, less than single digits for the full year. Sales going to be between $16.7 billion and $17.5 billion for the fiscal first quarter, below analysts' consensus of $17.9 billion. So it's not clear whether the market, you look at the US listed shares of TSMC, the ADRs were up 5%, other chip makers lower. I guess given the outlook broadly for consumer electronics demand, are they cheering that cutting capex? It's only very slight. On the other hand, as you say, when we look at the auto sector, and these are pretty basic semiconductors, things that are processors translating the push of a button to an electronic signal, actually we see more availability of supply and growth in that market in 2023, which of course is a boost for some of the automakers who left vehicles on the concrete, right, waiting for those chips to come through before they can be sold.
Craig, do you think these automakers will get some relief sometime soon?
Yeah, I think you look at what happened with Volkswagen sales last year, an 11-year low for them, 7% decline to just over 8 million. This is a company that for years in the lead up to the pandemic was doing 10 million plus units a year. And we know that this is a supply issue from just looking at the order book. They talked about 1.8 million vehicles just here in Western Europe that are ordered and awaiting delivery. So we know that, of course, this is a company that has had some issues with product appeal in China, has had some issues with software that potentially are costing it some customers. But this is absolutely the case that they also have some demand that they've been unable to meet because of the semiconductor issue continuing to give them problems.
The other big question as well for companies like Tesla is how much capacity do they need? Bloomberg learning that an expansion of Tesla's plant in Shanghai has been delayed over data concerns. Ed, can you run me through that one?
Yeah, I think that data concerns, this is an interesting one, reporting from sources over in Asia. I think the risk here is that you pump out vehicles at high volume that then don't get delivered, right? We know that in China, while there's been supportive policy and pullback on the COVID zero, the consumer is under pressure, but also there's a risk of the spread of the virus, which has impacted overall EV sales in that market in the months of November and December. There's a column out this morning from our colleagues at Bloomberg New Energy Finance, which says basically overall, globally, we'll see a slowdown in the demand we saw in 2022 for electric vehicles. Whether Tesla actually has a demand problem, we don't know. All we have to go on is the reporting. They've used the lever of price cuts, which is indicative that they are worried about the need to at least catalyze some new demand going forward, particularly in China.
Craig, let's finish there. China reopening. Is this the game changer or not? Can we just put a bow on that?
Yeah, I think there's absolutely the case that some car makers have pointed to this idea that they've just not been able to get people into showrooms. They've not been able to get staff into those showrooms or into offices. So will we see an uptick in some activity? Absolutely. I think the question, to Ed's point, is whether or not some of the issues that predate the most recent sort of round of lockdowns still have an effect on that market. When you talk about the property bubble and the sort of air coming out of that Musk pointed to quite a bit toward the end of last year, whether or not that continues to be something that plagues the industry going into 23.
Hey, Craig, thank you. Craig Truder over in London, Ed Ludlow here in New York. Thank you, gents. Appreciate it. Tesla getting hammered this morning. Again, the broader equity market totally rolling over here. We're down 0.6% on the S&P. On the Nasdaq, we're down 1 percentage point. Abby has the breakdown at the sector level. Hey, Abby.
Hey, John. Well, not surprisingly, we have most sectors lower with this decline. It sort of feels like it's out of nowhere, but it is somewhat substantial, down 0.6%. Now, the worst sector, healthcare, down 1.2%. We then have discretionary, tech, and communication services. So not surprisingly, those are your heavyweight tech sectors, the big weights to the S&P 500, and therefore you have the index lower. Energy is up 1%, as oil is also up 1.2%. But you know where I want to go? I was going to take a look at those techs rolling over, but they're not huge declines. The bigger declines are smaller names. Take a look at these moves on the year. Now, does this look like a recession to you, John? We have the airlines, as we've been talking about, up 18% on the year. Metals and mining, an expectation of the global economy, up more than 15%. And then entertainment and leisure products, all sharply higher. It does not look like, so far, investors investors are planning for a recession. Let's see what happens.
Hey, there's some big moves, aren't there? It's early days, but they're big moves. It's only January 12th. I keep saying that. We're already questioning the consensus view. You can hear the cracks in it. About 23 minutes into the session, we're down 0.7 on the S&P. The Nasdaq now down by more than 1%. Coming up, your trading diary.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Guessing the data is one thing. Anticipating how the market's going to react to it is quite another. In line on inflation, right across the board. Slap bang on estimates. Your equity market's lower by 0.75 to 1% on the S&P and the Nasdaq. We're down by 1.3%. That's the price action. Here's the trading diary. President Biden delivers remarks on inflation at the top of the hour. Plus, we hear from Fed Presidents Bullard and Barkin. More Fed speak from Williams, Kashkari and Harker. Coming up tomorrow, and it's the big banks tomorrow morning too. JP Morgan, Bank of America, Citi, Wells Fargo, kicking off earnings season. And finally, to get you to the weekend, we'll get you some new Mitch Consumer Sentiment Survey results to round out the week. From New York City, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the U.S. are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?